Please like, share, and subscribe. Wishing you happiness and good luck every day.
All right, let's talk about something that drives pretty much every investor crazy. You know the feeling. The market goes up, then it crashes down, then it rallies again. But when you look at your account after a year or 5 years, you've basically gone nowhere. So what do? Well, we're going to dive into the solution from Vitaliy Katsenelson's fantastic book, The Little Book of Sideways Markets. You know, when we talk about the market, it's always bulls versus bears, right? Up or down. Simple. But what if I told you there's a third animal in this financial zoo? A hidden player that's actually been running the show for long stretches of time without us even really noticing? Well, that third animal is what we call a sideways market. And the author, he has this brilliant nickname for it, the cowardly lion. Just picture it. It roars and charges forward like it's going to the moon, and then, poof, it gets spooked and scampers right back to where it began. It's a market with a whole lot of drama, a whole lot of noise, but in the end, you haven't really gone anywhere. So let's talk a little more about this third market animal. You might be thinking this is just a neat idea, but trust me, it's not just a theory. When you actually look back at the history, you realize this cowardly lion shows up all the time. It's a recurring pattern. Okay, take a look at this. This chart is, well, it's everything. It lays out the last 100 years of the market. See those huge, epic bull runs, like that incredible climb from 82 to 2000? Amazing, right? But look what happens immediately after each one. Bam. A long, frustrating sideways slog. It happened after 1906, after the Roaring '20s, after '66. This isn't a bug, you guys. It's a feature of the market cycle. So if history's any guide, what's in store for us? Well, you better buckle up, because we're in for a roller coaster. I'm talking about the kind with huge climbs that get your heart pounding and terrifying drops that make you question everything. But the real catch, after all that drama, after maybe a decade, you could look at your portfolio and realize you're right back at the station where you got on. Okay, so this is the going nowhere problem. And it just begs the question, right? How is this even possible? I mean, companies are still innovating, they're making more money. So why does the stock market just spin its wheels? Well, it all comes down to a giant game of tug of war. On one side of the rope, you've got the engine, earnings growth. Companies are making more money year after year. That's the force that should be pulling the market forward. But on the other side, pulling back with all its might, is this massive headwind called PE contraction. And all that really means is that investors just get, well, less optimistic. They're not willing to pay as much for the same dollar of earnings as they were before. And hey, this isn't just an abstract idea. Let's look at the hard numbers from 2000 to 2010. During that whole decade, company earnings actually grew by about 2.4% a year. Not bad, the engine was running. But the PE ratio, basically the market's enthusiasm meter, it fell off a cliff. It went from 30 all the way down to 19. That created a nearly 5% drag every single year. So you do the math, the negative force was way stronger than the positive one. The final score for a decade of investing? A big fat 0. So, if we're stuck on this roller coaster to nowhere, how on earth do you win? This is where we need a total shift in our thinking. It's not about finding some magic stock picking trick. It's about learning to befriend volatility. This right here, this is probably the single most important idea in the whole book. See, in a bull market, it's easy. A rising tide lifts all boats. But in a sideways market, that volatility, those scary up and down swings, that is the opportunity. You have to stop running from the waves and start learning how to surf them. They're what give you the chance to buy low and sell high. Now let's be super clear about one thing. This is not market timing. Trying to guess the market's next short-term move is a fool's errand. It's all driven by emotion. No. What we're talking about is something the book calls active value investing. It's not a guess, it's a repeatable process. It's a system for using the market's chaos to buy wonderful companies when everyone else is panicking and they basically go on sale. So that's the big question, isn't it? How do I actually do that? How do I know what to buy? Well, thankfully, the book gives us a super clear, really powerful system for it. It's called the QVG Framework. Yep, the entire process boils down to just 3 letters, Q, V, and G, quality, valuation, and growth. Think of this as your secret decoder ring for navigating this kind of tricky market. And this framework forces you to ask 3 simple but absolutely critical questions. And listen, the order here is everything. First, Q for quality. Is this an amazing business, period? Then, G for growth. Is it getting bigger and better in a sustainable way? And only after you've answered yes to those two do you get to V for valuation. Can I buy this great, growing business at a bargain price? So let's drill down into Q for quality. We're looking for companies with what the author calls a barbed wire fence around them, a competitive advantage so strong that nobody else can get in. Think of powerful brands, tons of cash flow, brilliant managers, and very little debt. This is the bedrock. If a company doesn't have quality, nothing else matters. Okay, next up, G for growth. And this is really important. Growth isn't just about selling more stuff. A great company can grow its profits by getting smarter, more efficient, widening its margins, or even just by buying back its own shares. The point is, you have to understand where the growth is coming from to know if it's real and if it's sustainable. And that brings us to V for valuation, which is honestly the most valuable player in a sideways market. This is where you figure out what the business is actually worth using a whole toolbox of methods. And then, and you have to hear this, you demand a huge discount. You need a large margin of safety. That means you only buy when the price is way, way below what you think it's worth. That gap, that margin of safety, that's your bulletproof vest against that nasty headwind we talked about. All right, so the QVG framework tells you what stocks to put on your shopping list. But now we get to the active part of active value investing. This is all about the execution. It's about how you buy and, just as importantly, when you sell. The old school buy and hold strategy is fantastic when the market's just going straight up. But in a sideways market, it's a recipe for going absolutely nowhere. The new strategy for this environment is active buy and sell. It's simple. You use the fear in the market to buy a fantastic QVV company when it's cheap. Then when the market gets greedy again and the price gets closer to what it's actually worth, you sell. You take your profit and go hunting for the next bargain. There is a quote about this I absolutely love. Marry your stocks, but with a prenuptial agreement. You should fall in love with the business, for sure. Do the homework. Know it inside and out. But you go into that relationship knowing exactly what will make you leave, and it's all based on valuation. Having that prenup takes all the emotion and guesswork out of selling. It's just part of the process. And this quote right here really gets to the heart of why this whole strategy is so robust. It's not just about asking, how much can I make if I'm right? It's about asking the much more important question, what's the cost if I'm wrong? So let's play this out. What if we're wrong and a monster bull market starts tomorrow? Well, what do you own? A portfolio of incredible growing companies you bought at a discount. You're going to do great. Okay, now what if the opposite happens and the market tanks? Well, remember that margin of safety, that huge discount you demanded? That's your safety net. That's your cushion against big losses. See? The strategy is built to be resilient, no matter what the market throws at it. So really, that's the bottom line. This whole approach is designed for resilience. And it all comes down to this one simple, but really tough question you have to ask yourself. Is my investment plan built for the reality of the market we have today, with this volatile, unpredictable, cowardly lion? Or is it based on the fantasy of the market I wish we had? Answering that honestly, well, that could make all the difference in the world.
Okay, so when you think about the stock market, what comes to mind? For most of us, it's one of two images, right? You've got the charging bull, all-powerful and optimistic, or you have the slumping bear, pessimistic and in full retreat. It's this simple up or down view that pretty much shapes everything we hear about investing. But what if I told you that's not the whole picture? Not even close. What if there's a third animal in the market zoo? One that's been hiding in plain sight for over 100 years?
Does that sound familiar? I mean, that feeling of being on a wild, stomach-lurching roller coaster. You get the incredible thrill of hitting new market highs, and then that gut-wrenching drop of a huge crash, only to look at your portfolio years later and realize you haven't really gone anywhere. It's basically a theme park ride for your savings. You get all the thrills, all the terror, but you get off right back where you started. This quote, I mean, it just perfectly captures what we're talking about today.
All right, so here's how we're going to break it all down today. First, we'll talk about that roller coaster ride. Then we're going to take a trip to the zoo to finally meet this mystery animal. After that, we'll look at a century of evidence because this isn't just a theory. Then we'll get into the two-part equation that actually drives all this. And finally, we'll wrap up by asking, what happens now?
Okay, let's dive into section 1, the roller coaster ride.
This is all about getting to the bottom of that really weird, really frustrating feeling of massive market action, tons of volatility, breathless headlines, all the drama. But at the end of the day, no real forward progress for the long-term investor. It is, kind of ironically, the perfect definition of going nowhere fast.
Right, so this is the big question, isn't it? It's on every financial news channel, it's what everyone talks about. Are we going up or are we going down? We're so conditioned to see the world this way, in these two buckets, trying to slap a label on the market at any given time. But the big idea we're digging into today is that maybe, just maybe, this question is missing the point.
And here, this is where it gets really, really interesting. What if the answer to bull or bear is actually neither? What if there's a third state the market can be in? And not for just a few months, but for years, even a decade or more. A state that isn't about a glorious climb to the moon or a painful slide into a ditch, but something else entirely.
And that, of course, brings us to our next stop, a trip to the zoo. It's time we officially expanded our vocabulary, moved beyond that simple world of just bulls and bears, and finally introduced the animal that really completes the picture of how markets behave.
Okay, so we all know these two characters, right? The bull market, that's the amazing long-term climb where you feel like an investing genius. The source material calls this a secular bull market. When you hear secular, just think long-term, like a generational shift. And on the flip side, you've got the dreaded bear market. Falling prices, pessimism, fear. Pretty simple. That's investing 101.
All right, so it's time to meet our third animal. This is the sideways market. And notice, it's also a long-term secular condition. It's a market where, even though you have entire bull and bear markets inside of it, the overall big picture trend is flat. The market makes a ton of noise, it goes up, it goes down, but over a decade or more, it's basically just treading water. This isn't just a correction, it's a prolonged state of going absolutely nowhere.
And to really give this market a face, the source material comes up with an absolutely brilliant mascot, the Cowardly Lion. And honestly, this is perfect because it just nails the behavior. Think about it. The market shows these bursts of incredible bravery. It roars ahead, making investors feel confident and optimistic again. But that bravery never lasts. It's quickly followed by fear, which sends the market slinking right back to where it started. It so desperately wants to be a bull, but it just can't find the courage to follow through.
Okay, so I know what you might be thinking. This is a neat idea, a fun metaphor, but is it real? Well, it's not just some clever theory cooked up to explain a few bad years. And that brings us to our third section, a century of evidence. We're about to see that this cowardly lion has been a regular visitor throughout modern market history.
Okay, take a look at this. This chart is really the smoking gun. It shows the Dow Jones going back over 100 years, and the pattern is it's undeniable. You can see these long, distinct periods. Look right here on the screen. From about 1906 to 1924. That's a long sideways grind. And then you see another one from the late 30s to the late 40s. And again, look at this one, from the mid-1960s all the way to the early 80s. The rhythm of history here is crystal clear. A massive, long-term bull market is almost always followed by an equally long sideways one.
And just think about that last great bull market, the one from 1982 all the way to the year 2000. It was an absolute monster. For 18 straight years, the market was in this powerful, life-changing uptrend that really defined investing for an entire generation. Now, based on that historical pattern we just saw, what do you think happened next?
You guessed it, and this next chart, well, it has another great name for it, the sideways foxtrot. Just look at the dance steps here on the screen. The market takes a big step back with the bear market from 2000 to 2002. Then it takes a confident step forward with the bull market up until 2007. And then it takes an even bigger, more brutal step back in the crash of '08. After a full decade of this crazy dance, where were investors? Right back where they started in the year 2000. That, my friends, is a cowardly lion market in action.
Okay, so at this point, we've established what a sideways market is. We've seen that it's a real thing that actually happens. But the million-dollar question is, why? Why does this happen? That brings us to section 4, the two-part equation, where we're going to look under the hood at the engine that drives these huge, decade-long trends. Now, this is where things get really, really surprising, because the answer is probably not what you think. You'd assume that bull markets happen when the economy's roaring and sideways markets happen when the economy is in the gutter, right? But when you actually look at the historical data, the growth of the economy and corporate profits,
Well, they didn't really change all that much between the bull periods and the sideways periods. This is a huge deal, because it tells us the stock market isn't just a simple mirror of the economy. There's something else going on, a much more powerful factor.
And this is it. It all comes down to this one simple formula. Seriously, this is the only thing you need to understand. A stock's total return comes from three places. We're going to focus on the two big ones: how much money a company makes, that's earnings growth, and, this is the crucial part, how much investors feel like paying for those earnings. And that feeling, that human sentiment, is all wrapped up in the change in the PE, or price-to-earnings ratio. All a PE ratio tells you is how many dollars investors are willing to pay for $1 of a company's profit. So let's break that down, because this is the absolute key. Part 1, earnings growth. That's fundamental. Of course, companies have to make more money over time. But Part 2, that change in what people are willing to pay, that's the wild card. During a big bull market, everyone's optimistic. Investors get excited, and they're willing to pay more and more for each dollar of earnings. So the PE ratio gets bigger, and it acts like a giant tailwind pushing returns higher. But in a cowardly lion market, the mood gets sour, that optimism disappears. Investors just aren't willing to pay as much, so the PE ratio shrinks. And that shrinking PE acts like a massive headwind that can completely wipe out any growth in the actual company's profits. That's the secret.
All right, so with all of that in mind, let's land the plane and talk about our final section. What happens now? We've gone through the concept, we've seen the history, and we've peeked at the mechanics. Now let's bring it all together and figure out what this means for us today.
So, let's just do a super quick review of what we've covered, the big takeaways. First, we have to expand our vocabulary beyond just bull and bear. The sideways or cowardly lion market is a real, distinct third possibility. Second, this isn't a new idea. It's a clear, repeating pattern we can see in over a century of data. Third, these aren't just short-term moods. These are long, grinding periods that can last for a decade or even more. And finally, the key driver isn't just the economy, it's investor sentiment. It's not just about what a company earns, but about how investors feel about those earnings.
And that really brings us to the final and maybe most important question of all. The entire foundation of modern investing is built on the idea that a buy and hold strategy is the guaranteed path to success. And that works beautifully in a long-term bull market. But the source material here makes a really compelling case that in a long-term sideways market, that very same strategy becomes a ticket to nowhere. It completely flips conventional wisdom on its head. So the question that leaves us with is, if the old map doesn't work in this kind of territory, what kind of navigation do you need? That's a question worth thinking about. Thanks for joining us.
Have you ever felt like the stock market has a kind of split personality? 1 minute it's euphoric and optimistic, and the next it's plunging into despair. Well, it turns out there's a reason for that. Today we're going to pull back the curtain and look at the predictable forces that are actually driving these wild mood swings.
So let's kick things off with a really basic question. It seems like common sense, right? If a company is just crushing it, growing its business, making more and more money every single year, its stock has to be a great investment. But what if I told you that for really long stretches of time, that perfectly logical idea is just flat out wrong?
Okay, take a look at this chart. This is Walmart's stock from the end of 1999 all the way to early 2010. As you can see, it was a total roller coaster. Lots of crazy ups and downs. But if you just look at where it started and where it ended, you'll see that after more than 10 years, the stock went absolutely nowhere. For shareholders, it was basically a lost decade.
But here's where it gets really weird. While the stock was just treading water, the business itself was on fire. During that exact same time, Walmart's earnings didn't just grow a little bit, they nearly tripled. That's a growth rate of almost 12% a year. So what gives? How on earth can a company triple its profits while its stock price goes nowhere?
And here is the answer. This is really the key to this whole thing. You had two powerful forces in a tug of war. On one side, you had that fantastic earnings growth, pulling the stock's value up. But on the other side, you had this massive headwind, the valuation, which we measure with the price to earnings, or PE ratio. See, back in 1999, investors were so excited they were willing to pay 45 times the company's annual earnings for one share. But by 2010, that excitement had vanished. They were only willing to pay less than 14 times. That collapse in valuation completely, 100%, canceled out a decade of amazing business growth.
That Walmart story, it's the perfect miniature version of what happens to the entire market. The market isn't just one thing. It has these really distinct, long-term personalities. You got your classic bull markets, your scary bear markets, And then you have those long, frustrating sideways markets, the cowardly lions, that just don't seem to go anywhere for years. And just like we saw with Walmart, the fate of the entire market always comes down to a battle between those same two forces. Force number one, how much are companies actually earning? That's the real fundamental engine of growth. And force number two, how much are investors willing to pay for those earnings? That's the PE ratio, and it's the engine of human emotion and expectation.
This little table just breaks it down beautifully. A real, roaring bull market, that's what you get when you have decent economic growth, but you're starting from a point of pessimism, a low PE ratio. Now, a sideways market, like the one Walmart had, happens when you've got that same decent growth, but you're starting from a place of huge optimism, a high PE. And the dreaded bear market, well, that's the absolute worst combination, a bad economy and a high starting valuation.
And believe me, this isn't just a theory. Let's look at another real-world example. This is the Dow from 1966 all the way to 1982. It looks a lot like that Walmart chart, doesn't it? This was a brutal 16-year-long sideways grind. Now, during this time, the economy and company earnings were actually growing okay. But because investors started out paying a really high PE ratio, that valuation slowly bled out, wiping out all the gains and leading to a long, painful period for investors.
All right, so we get it. The PE ratio is a big deal, but let's actually put some numbers to it. Let's look at the math and see exactly how this one little number can act like rocket fuel for your returns or a massive anchor weighing them down. And to see this power in action, we're going to use one of the greatest bull markets of all time as our case study, the incredible run from 1982 to the year 2000. This was a period that created massive wealth and pretty much convinced an entire generation that stocks were a one-way ticket up.
Okay, so during this amazing run, corporate earnings grew at a solid 6.5% per year. That's a good, healthy number. If that's all investors got, it would have been a pretty decent outcome. But that, my friends, is only half the story.
Because we have to add the second explosive ingredient, the change in what people were willing to pay.
And there it is. Over those 18 years, the market's PE ratio went from a pessimistic low of around 10 all the way up to a euphoric high of 30. That expansion of the multiple added another 7.7% per year to investor returns. Think about that. The return from sentiment was even bigger than the return from actual business growth.
So what happens when you combine solid earnings with that massive tailwind from people just getting more and more optimistic?
You get an absolutely mind-blowing 14.7% return year after year. And get this, that's before you even count dividends. It just goes to show you that the legendary returns of that era were driven more by a change in mood, that expanding PE, than by the actual underlying performance of the companies.
So this brings up the obvious next question. If the PE ratio is really that powerful, what's pulling the levers? Why does it swing so wildly from a pessimistic 10 to a euphoric 30? Well, the answer isn't in some complex economic model. It's inside our own heads.
The father of value investing, Benjamin Graham, he absolutely nailed it. The market isn't some cold, calculating machine. It's a mirror reflecting our own human psychology. It's driven by the collective hope, fear, and greed of millions of investors. And as we all know, those emotions are anything but rational or stable.
And this emotional roller coaster follows a surprisingly predictable path. It all starts with normalization. PE ratios are low, so they start to rise back to average, which makes sense. But then, as the good returns keep coming, people start to think it's a new paradigm, that high returns are the new normal. Then you hear the foremost dangerous words in investing, this time is different. People justify crazy high PEs with new technology or some new story. But eventually, the PE expansion has to stop. Returns fall back to just what companies are earning, and everyone feels disappointed. And that's when the cycle reverses, PEs start to fall, and you get another sideways market or lost decade.
So what do we call this huge, overarching force that governs these emotional cycles? There's a name for it, and it's maybe one of the most important concepts in all of finance. The best way to think about it is with the metaphor of a simple pendulum.
The concept is called mean reversion. And honestly, it's as fundamental to investing as gravity is to physics. All it means is that things that get stretched way too far in one direction, like valuations, feel this powerful, almost magnetic pull back toward their long-term average. But here is the critical point that almost everyone gets wrong. Mean reversion doesn't mean things go back to average and then just stop. No way. Because we're talking about human emotions, the pendulum doesn't just settle calmly in the middle.
It swings right through the average on its way to the opposite extreme. And this captures it perfectly. You have the market swinging between two emotional poles. On one side, you have greed and euphoria, which create those dangerously high PE ratios. And on the other, you have fear and despair, which create irrationally low PE ratios. The entire history of the stock market is just the story of this pendulum swinging, endlessly, between those two states.
And get this, the market spends only about a quarter of its time in what you might call the sane zone, somewhere near its long-term average valuation. The other 75% of the time, it's either way too expensive or way too cheap. It's almost always in a state of either irrational optimism or irrational pessimism. The average is just a place it passes through on its way from one extreme to the other.
So this leaves us with the single most important question we can ask as long-term investors. If the market really is just a giant pendulum of human emotion, swinging back and forth between fear and greed, then the real question isn't what's the hot stock for next quarter. The real question is, where are we in the pendulum swing right now, and what does that mean for the decade ahead?
All right, let's jump right in. We're going to tackle a huge question today. What is the market really trying to tell us? It's so easy to get wrapped up in the story we want to hear, but the actual message? Well, that could be something else entirely. So let's not shoot the messenger. Let's figure out what it's saying.
Okay, so what's the first question on literally every investor's mind all the time? Are we in a bull market where everything's shooting for the moon? Or are we in a bear market where everything's falling apart? It's got to be one or the other, doesn't it? Well, here's the twist. For a pretty long time now, the real answer has actually been neither of them. Turns out there's a third direction the market can go, one that most people completely overlook, and understanding it, it's everything.
So here's our game plan. First, we're going to define this mysterious third direction. Then we're going to hop on a little metaphorical train to figure out just how long this ride might last. After that, we'll check the weather forecast by looking at inflation. Then we'll uncover the surprising place returns actually come from when the market is stuck in neutral. And finally, we'll see why the old playbook for investing might be totally obsolete.
All right, first up, the market's third direction. What we're talking about here is a sideways market. Think of it as a long, long period, sometimes more than a decade, where the overall market just goes nowhere. It grinds back and forth, but doesn't make any real upward progress. And to see it, we need the right tool. And that tool is the price-to-earnings ratio, the PE. It's the classic way to tell if the market is cheap or expensive. Now, the P for price is simple, right? That's just the S&P 500 level. But the E for earnings, that is where things get tricky. You see, corporate earnings can swing like crazy from one year to the next, thanks to the ups and downs of the economy. So if you're only looking at 1 year's worth of earnings, you can get a totally warped picture. It's a noisy signal that can fool you into thinking the market's cheap when it's actually expensive, or vice versa.
And you can really see the difference right here. On the left, using just 1 year of earnings, the valuation line is all over the place. It's just a mess of noise. But now look at the right. When we smooth out those earnings over 10 years, suddenly a really clear pattern shows up. Those long cycles of bull and sideways markets just pop right out. It's a much, much better map.
And when we look at that clearer map, we find something absolutely critical. The sideways market that we've been in since around the year 2000, it started from a PE of 48. That is the highest, most expensive valuation ever recorded in the history of the US stock market. And that starting point, it changes everything about how long this journey could take.
So if we started at this historic Mount Everest of a peak, how long is it going to take to get back down to a more reasonable valuation? To make sense of this, let's imagine the market is on a train journey. I know, it sounds a little silly, but this metaphor makes a really abstract idea feel super tangible.
Think about it. Every train trip has 4 basic parts. You've got your starting station, that's our high PE. You have a destination, a low PE. You have the distance, which is just the gap between those two valuations. And you have the speed of the train, which is how fast corporate earnings are growing. That's it. Those 4 things tell us how long the trip is going to take.
So where did our train pull out of the station? Well, using our 10-year smooth earnings, our starting PE in the early 2000s, right after that bubble popped, was around 23. Let's call that high PE station.
And where are we headed? Well, historically, these long sideways markets don't end until the market's PE gets cheap, like really cheap, well below its long-term average. So our destination, based on history, is a PE of around 13. Welcome to low PE station.
And how fast is this train moving? Well, the long-term average speed, our nominal earnings growth, has historically chugged along at about 5% per year. That number includes both real growth and a little bit of inflation.
So, what happens when you plug in all the numbers? You're going from a PE of 23 down to 13, and your earnings are growing at 5% a year. The math says that journey should take about 11.7 years. And get this, that's just the travel time. That doesn't even count how long the market might just sit at the destination before the next big bull market finally kicks off.
Of course, no trip is ever perfectly smooth, right? There's always the weather. And that brings us to our next piece of the puzzle, inflation's 3 zones. You can basically think of this as the weather conditions our train has to drive through.
This chart here is our weather map. Those jagged lines are inflation and short-term interest rates over the decades. And as you can see, they create 3 very distinct zones, or climates, that can seriously speed up or slow down our train's progress.
So let's break them down. Right in the middle, you've got what's called the zone of peace. This is where inflation is stable, predictable, it's perfect weather. But below that, you have the dead zone of deflation, which is a total disaster for corporate profits. And above it, you have the dead zone of inflation, where high inflation just eats away at the real value of any future earnings.
So the rule of thumb is really simple. Any movement towards that nice calm zone of peace in the middle, that's good for the market. It lets PE ratios expand. But any movement away from the zone of peace into either deflation or high inflation, that's bad. It crushes PE ratios and makes our train's journey even longer.
So if we can't count on rising PE ratios to give us a boost, where do our investment returns even come from in a sideways market? And this brings us to a part of the story that is so often ignored. It's the unsung hero of this whole thing: dividends.
Now, I want you to really let this next point sink in, because it's probably the most important takeaway from this whole explainer. In the last 3 major sideways markets, dividends were responsible for over 90% of stock market returns. Think about that. Almost all of the gains came from the cash that companies paid out, not from stock prices actually going up.
And when you see it visually, it's just undeniable. In these long, flat markets, the gains you get from prices rising are practically a rounding error. The return you get from dividends is pretty much the entire game. And this leads us to a really uncomfortable question. You see, historically, these sideways markets usually ended when dividend yields were way higher, think 5 or 6%. But today, the market's yield is closer to 2%. So, if 90% of your future returns are supposed to come from that tiny 2% yield, what does that tell you about your total potential return? It kind of suggests a future of incredibly low returns, maybe just barely enough to keep up with inflation. It's a really sobering thought. And all of this leads us to our final and maybe most important point. If the overall market isn't going to do the heavy lifting for you, how do you actually succeed? Well, this is why the right stocks rule, and it's all about the massive difference between active and passive investing.
First, let's look at the great bull market from 1982 to 2000. Look at that top line. The S&P 500 just absolutely demolishes the returns from bonds and cash. This is a perfect example of a rising tide lifts all boats. You didn't have to be a stock-picking genius. You could just own a simple index fund, and you did great.
Now let's contrast that with the sideways market from 1966 to 1982. It is a completely different universe. I mean, look at how the lines for stocks, bonds, and cash are all tangled up in a big knot. In this world, the average stock, the S&P 500, barely did better than stashing your money in risk-free treasury bills. Just being in the market wasn't enough. That rising tide was gone. So the bottom line is this: your strategy has to match the environment. In a roaring bull market, passive indexing is fantastic. You have a huge tailwind from PE expansion. But in a sideways market, being average is a recipe for going nowhere. You don't have that tailwind anymore. Success depends entirely on rigorous stock selection, actively finding the right companies to own.
And so that's the ultimate question we're left with. If just owning the market index could lead to a decade of disappointment, and only the right stocks are going to deliver any kind of meaningful return, what exactly makes a stock one of the right ones? That's the challenge for every investor trying to navigate a sideways world.
You know, what could a fictional milkman from a tiny European village possibly teach us about today's crazy financial markets? Well, as it turns out, a whole lot. So let's follow Tevye to the market, because this 19th century milkman is about to give us a masterclass in how to invest like a pro.
Yeah, you probably know Tevye from the musical Fiddler on the Roof. But today, we're not talking about tradition or matchmaking. Today, we're meeting Tevye, the value investor. He's a hero for anyone who wants to just tune out all the noise and focus on what a business is actually worth.
All right, here's our game plan. First, we'll meet our unlikely hero. Then we're going to crunch the numbers to figure out what a cow is really worth. After that, we'll get into the super important margin of safety. We'll see how Tevye handles the wild mood swings of the market, and then, at the end, we'll put it all together.
Okay, so let's set the scene. Tevye is a milkman. He needs to buy a new cow. And this simple, everyday task, it's going to be our deep dive into value investing. The cow, well, that's our asset. Think of it like a stock. And Tevye is our guide to figuring out what it's truly worth.
You know, when it comes down to it, there are really two ways to approach investing. On one side, you've got the speculator. They get swept up in the hype, hoping to flip an asset to a bigger fool tomorrow. And then, you have the investor, like Tevye. His approach is all about discipline, analysis, and patience. It's a really powerful difference.
So, Tevye needs to buy this cow. He's already got a name for her, Goldie. But before he even thinks about making an offer, he has to answer the single most important question in investing: what is this thing really worth? This is where we get into the nitty-gritty.
Tevye, using all his years of experience, he just starts forecasting. He figures, okay, Goldie can probably bring in $1,000 a year from milk, and maybe another $500 from selling a calf. So that's a nice, steady $1,500 a year for, say, 5 years. And at the end of all that, her terminal value is about $500. Simply enough.
So his first pass is just simple math. He just adds it all up. $1,500 a year for 5 years, that's $7,500. Plus that final $500, that gives him a grand total of $8,000. So right away, he knows it would be insane to pay more than that. But is that what she's worth today?
And this is where Tevye really puts on his investor hat. He's using a method that financial analysts use every single day. It's called discounted cash flow, or DCF. The idea is really simple. A dollar in your hand today is worth more than a dollar you might get next year. He's laying out all the cash he expects to get, and then he starts figuring out what that future money is worth right now.
Now, here's where it gets interesting. Tevye's banker son-in-law makes him an offer that teaches us something huge. He says, hey, I'll give you $7,000 today for all of Goldie's future earnings. What that does is it reveals a 6% discount rate. That accounts for things like inflation or what Tevye could earn on that money somewhere else with basically no risk. So if the future was a sure thing, Goldie would be worth $7,000. But the future is never a sure thing, is it?
Of course not. The real world is messy and full of risk. I mean, Goldie isn't some government bond. She's a living, breathing animal. She could get sick, the price of feed could go through the roof, a new farm could open up down the road and drive down milk prices, taxes could go up, a million things could go wrong with his perfect little forecast.
So, to adjust for all that risk, Tevye does something really, really smart. His gut, his experience, it all tells him he needs to demand a higher return to make up for all those unknowns. So he doubles that discount rate from a riskless 6% to a risky 12%. And when he crunches the numbers again, boom. The present value of all that future cash drops to $5,700. This is his estimate of Goldie's true intrinsic value.
But wait, he's not done yet. Not even close. Knowing what something is worth is only half the battle. Deciding what price to actually pay for it, that's another thing entirely. And that brings us to what might be the single most important concept in all of value investing. It's funny, Tevye definitely never read Benjamin Graham's books, but he lived by the man's words. Graham is the father of value investing, and his core idea is this: your real protection, your safety net, it doesn't come from being a perfect forecaster. It comes from the price you pay.
So what the heck is a margin of safety? It's just a buffer. It's a cushion. It's the gap between what you think something is worth and the price you're actually willing to pay. Tevye is smart enough to know he could be wrong. I mean, things usually go more wrong than right, don't they? This buffer is his protection.
Okay, so let's just quickly recap Tevye's whole thought process here. We started with the simple pie-in-the-sky sum of $8,000. We discounted that for time and got to a riskless value of $7,000. Then we got realistic, discounted for actual business risk, and landed on an intrinsic value of $5,700. And finally, Tevye demands a 25% margin of safety, bringing his absolute top purchase price down to just $4,300. Now he's ready.
So Tevye's got his number, $4,300. He heads down to the livestock auction, which is basically his version of the stock market. And just like the stock market, it's a place driven by emotion, by rumors, by the weather, by the psychology of the crowd. And what he finds is just classic market behavior. On day one, the sun's out, everyone's feeling great, and people are bidding prices up like crazy. Farmers are turning into speculators. But by day three, oh man, the weather turns, moods get sour, and panic starts to set in. Those same speculators are now desperate to sell at any price, and that is when the real investor sees an opportunity. Tevye also has this handy little shortcut to check the market's temperature. He looks at a price-to-cash flow multiple. He knows from experience that a fair price for a cow is usually around 3.8 times what she earns in a year, which, hey, lines up perfectly with his $5,700 valuation. But he sees people on the sunny day paying 7, even 8 times cash flow. That's euphoria. His target price of $4,300 works out to about 2.9 times cash flow, a total bargain compared to what's normal. And at the auction, Tevye overhears this absolute gem of wisdom. Some young farmer is bragging about getting a cow for 7 times cash flow because yesterday it was 8 times. But this old farmer just shakes his head. The price some other fool paid has absolutely nothing to do with how much money that cow is going to put in your pocket.
So, on that rainy, miserable third day when everyone else is panicking, Tevye calmly finds his Goldie. She's a great cow, and he buys her for his price, $4,300. He didn't get swept up in the madness, he just stuck to his process. So let's nail down exactly what that process was.
When you boil it all down, Tevye's whole method is just 4 simple steps. 1. Understand the business well enough to estimate what drives its value. 2. Calculate what it's actually worth. 3. And this is the big one, demand that margin of safety by setting your buy price way below its true value. And finally, 4. Have the patience and the discipline to just wait for the market to give you your price.
And that really brings us to the most important lesson here. Tevye had no idea if he bought Goldie at the absolute bottom. And you know what? He didn't care. Trying to perfectly time the bottom of the market is a game for fools. He knew he'd bought a great asset at a great price with his safety net built right in. That's how you win this game in the long run. So that leaves us with one final question to think about. When you're looking at an investment, are you really doing the work like Tevye, calculating value, understanding the risks, and demanding a margin of safety? Or are you just getting caught up in the story, the excitement, and gambling on the price going up tomorrow? Tevye's simple wisdom shows us there's a much, much better way. All right, so get this. What if I told you that a loud, kind of drunk guy at a blackjack table could teach us one of the most powerful lessons about making better decisions, not just in a casino, but with our money, in our lives? Today, we're diving into a story that shows why the way we usually think about winning and losing is often completely upside down.
So here's how we're going to break it down. We'll start with our 2 gamblers. Then we'll see how doing everything wrong can somehow, magically, lead to a win. Next, we'll get into the huge difference between a good process and a lucky outcome. We'll see how all of this applies directly to investing. And finally, we'll talk about a whole new way for you to judge your own decisions.
And really, this is the big idea we're circling today. Real, lasting success, especially when it comes to something like investing, it's not about that one lucky break. It's about building a solid process that you can count on again and again. Okay, let's set the scene. We're at a casino at a blackjack table. But this isn't really about cards. This is like a perfect little laboratory for decision-making, where the line between a good choice and a bad one is about to get really, really fuzzy. So our narrator, he's in a casino on a work trip. And he's being smart about it. He knows the house always has an edge, so he gives himself a strict $40 limit. That's it. His goal isn't to strike it rich, it's just to hang out, make the money last, and play using a statistically sound strategy. He has a plan. He has a process. And then, at the same table, you've got our other guy, a loud, rowdy dude who is his polar opposite. He's flashing a fat stack of hundreds, shouting about how it's his payday. So while our narrator is carefully playing by the book, this guy's just making wild, chaotic bets. You couldn't imagine 2 more different approaches. And this, my friends, is where things get wild. Because everything you think should happen next, all the logic, all the statistics, it's about to be completely ignored. For a little while, anyway.
I mean, this guy was making moves that were just statistically insane. At one point, he has a hard 18. That's a really strong hand. The dealer is showing a 6, which is a terrible card for them. The book, the math, everything says you stay. You never take another card. So what does he do? He screams, "Hit me." And wouldn't you know it, the dealer flips over a 3. He gets a perfect 21. And this just kept happening. Every awful decision he made, he got rewarded for it. His pile of chips got bigger and bigger. He's loud, he's winning, and a crowd starts to form. You can hear people whispering, "Wow, this guy's amazing." And at the exact same time, our narrator, the one playing perfect by-the-book blackjack, he's getting absolutely destroyed. Every correct move he makes, he loses the hand. His little $40 stack is just melting away. He's quiet, he's focused, he's losing, and nobody even notices he's there.
So if you're just watching this scene, what do you conclude? It looks for all the world like the crazy impulsive guy is a genius and the careful strategic guy is a fool, right? I mean, was the book wrong all along?
Nah, of course not. Because in the long run, luck is a terrible strategy. After a couple of hours, his luck just ran out. The basic math of the game, what they call the law of large numbers, it always wins. He started losing, and since he had no real strategy, he just bet bigger, trying to win it all back. And in the end, he lost every penny he'd won, plus his entire paycheck. So what on earth was going on here? This story is just a brilliant real-world example of one of the most important ideas in decision-making, the huge, massive difference between your process and your outcome.
You see, the hidden variable, the thing that was messing with everyone's heads, was just randomness. It was pure dumb luck. In the short term, randomness can make a great decision look stupid and a terrible decision look brilliant. It can reward bad behavior and punish good behavior. And if you're not careful, it can teach you the exact wrong lesson.
And that leads us to the real key. We have to get good at separating the quality of our process from the quality of a single result. Because when you're dealing with anything that involves luck, a good process is the only thing that's going to lead to success over the long haul.
You know, the poker player David Sklansky put it perfectly. He said that when you make a bet with the odds in your favor, you've earned something, even if you end up losing the hand because of luck. And when you make a bet with the odds against you, you've lost something, even if dumb luck happens to hand you a win.
Okay, so a blackjack story is fun, but what does it have to do with the real world? Well, let's take this idea from the casino and apply it to something with much higher stakes, investing your money.
When you look at all the truly great investors, what do they have in common? It's a deep, almost obsessive focus on their process. Yeah, luck plays a part in any single year's returns, but they know you can't control luck. It's totally unpredictable. The only thing you have any real control over, the only thing you can improve, is your process for making decisions.
Now, we hear the word discipline all the time in investing, but it's a bit tricky because it can mean two different things. First, it can mean having a system of rules. That's what we've been calling a process. But second, it can mean having the willpower to actually stick to those rules, especially when it's emotionally difficult.
So just so we're all on the same page here, when we say process, we're talking about your system, your rules for how you invest. And when we say discipline, we're talking about the mental toughness to actually follow that process, even when the market is going crazy.
And this takes us right back to our friend at the blackjack table. See, his problem wasn't just that he lacked discipline. It was deeper than that. He had nothing to be disciplined to. He had no process in the first place. And when you have no process, discipline is impossible, and long-term failure is pretty much guaranteed. Okay, let's bring this all home. How can we actually use this idea to get better at evaluating our own choices day in and day out? Our brains just love shortcuts, and judging a decision by its outcome is the easiest shortcut there is. Did I make money? Must have been a good decision. Did I lose money? Oh, that was a terrible decision. It's simple, it's clean, and it feels right. But, as we've just seen, it's also incredibly misleading. It totally ignores the role of luck. So let's recap the big takeaways. First, we have to accept reality. A good process can have a bad outcome, and a terrible process can get lucky. Second, we have to stay on guard because randomness is always trying to teach us the wrong lessons. Third, we have to burn this into our brains. Over the long run, a good process is the only thing you can rely on, and all of that leads to the golden rule. Judge yourself on the quality of your decision-making process, not on the random, short-term result.
So I'll leave you with this question to think about. That last big decision you made, maybe an investment, a choice at work, whatever, when you look back on it, are you judging it based on the outcome? whether you got lucky or not, or are you focused on whether you had a thoughtful, repeatable process? The answer to that question says everything about your chances for future success.
Hey there, and welcome to The Explainer. Today we're talking all about the letter Q. And no, not in the way you might think. We're talking about Q for quality. What does it actually mean to be a quality company? You know, in today's crazy up and down markets, figuring this out isn't just some nice to have, it's literally the key to smart investing. So let's kick things off with a piece of advice that sounds almost too simple. Don't lose money, right? Obvious. But here's the thing. It's especially critical when the market is just flat, grinding sideways. Why? Well, think about it. When there's no big wave lifting all the boats, trying to make back money you've lost is an uphill battle, a really, really steep one. So the real game becomes about not losing it to begin with. And how do you avoid losing money? Well, that's where quality comes in. It's the answer. So what is a quality company, really? We're talking about a business that has real, durable, long-term earning power. You know, the kind of company that can face down an economic hurricane and walk out the other side, maybe even stronger than it was before. All right, so that's the goal. But how do we actually find these kinds of companies? Well, that's what we're going to break down today. First, we'll look at what's called a competitive advantage. That's the fence that protects a company. Then we'll talk about why cash flow is king, not earnings. We'll also get into the tricky business of analyzing management. After that, we'll touch on predictability and why it matters so much. And don't worry, we'll wrap it all up with a handy checklist you can use. Okay, let's jump right in with the first and, honestly, the most important piece of the puzzle. How does a great company keep its profits safe from competitors? Simple. It builds a fortress. A big electrified fence to keep the wolves at bay. I love this analogy. Think about it. A business that's making a ton of money, really high returns, it's like putting out sugar water for hummingbirds. It's just too sweet to ignore. You're gonna attract a crowd. And in business, that crowd is your competitors, all wanting a piece of the action. So, to survive that onslaught, a company needs a defense. The source we're looking at calls it a metaphorical barbed wire fence. You might have also heard it called an economic moat. Whatever you call it, it's that sustainable competitive advantage that is super, super hard for anyone else to get across. It's what lets the company keep all that sweet profit for itself. And this fence, this advantage, it can come from all sorts of places. Maybe it's a brand that everyone knows and trusts, or maybe it's just ridiculously expensive for a new player to even get into the game. It could be ironclad patent protection, or just a killer business model that churns out high returns on capital. But here's the key takeaway for this section. Whatever form it takes, this is the one thing you can never compromise on. But, and this is a big but, you have to be careful. Not all brands are created equal. They don't all give you that same barbed wire protection. Take a company like the old Sara Lee. I mean, they had tons of famous brands, right? Hillshire Farm, Hanes, you name it. But here's the problem. If they tried to bump up their prices, people would just switch. They'd buy the other well-known brand right next to it. So their brands gave them the right to compete, to be on the shelf, but not the power to set their own prices. And that, right there, is a massive difference. All right, so a company has this great competitive fence. How does that actually show up in the numbers? Well, that brings us to our next point, which is all about the lifeblood of a business, cash. Cold, hard cash. Because let's be real, you can't go out and spend accounting earnings. This is so important. You have to learn to look past the headline number, the earnings per share. I mean, that number can be massaged and manipulated to hit whatever Wall Street wants to see. What you really need to focus on is free cash flow. This is the real deal. It's the actual cash a company has left in its pocket after paying for everything. Salaries, taxes, and all the money it needs to reinvest just to maintain the business and hopefully grow it. And even within that reinvestment bucket, you've got to make a really key distinction. You have to figure out how much money the company is spending just to stay in the same place, running on a treadmill. A good example is a chip company that has to constantly upgrade its factories. You have to separate that money from the cash it's spending to actually get bigger, like a retailer opening up brand new stores. Here's a perfect example. Walmart. For years, they were in growth mode, right? Opening new stores like crazy. But once they started to slow that down in the US, their spending on growth dropped way off. And what happened? Their free cash flow went through the roof. It basically exploded, jumping from $5 billion all the way up to $12 billion. It just goes to show you the incredible power that gets unleashed when a company shifts from just growing for growth's sake to actually maximizing its cash. Okay, so we've got a great business with a strong fence, gushing cash. What could possibly go wrong? Well, that brings us to the human element. The one thing that can torpedo even the best business model out there: management. We've got to talk about the people who are in charge of spending all that money. This quote from the legendary investor Bernard Baruch just says it all, doesn't it? It's a perfect reminder to always, always be skeptical. You have to watch what executives do with the company's money, not what they say. I mean, their actions speak so much louder than any polished speech on an earnings call. So this is the million-dollar question you have to ask yourself every single time. Are the people running this company actually good at spending your money? Because that's what it is. Are they good stewards of that capital? Or are they just trying to build a bigger empire for themselves, destroying value along the way? Let me give you a perfect and kind of scary cautionary tale. Regis Corporation. On paper, this business looks amazing. It's the biggest hair salon company in the world. I mean, how simple and predictable is that? People's hair is always going to grow, right? The business just prints cash. So what could possibly go wrong? Well, a lot, it turns out. The source we're pulling from has this perfect, if frankly terrifying analogy. Having too much cash combined with incompetent management, it's a recipe for total disaster. They say it's like giving whiskey and car keys to a bunch of teenage boys. You just know. You know it's not going to end well. And yeah, it really didn't. Over 10 years, the management at Regis took this beautiful cash printing machine and ran it into the ground. Get this, they doubled sales, but earnings per share went nowhere, flat. They piled on more debt. They diluted their own shareholders by printing almost 40% more stock. And to top it all off, they blew a jaw-dropping $1 billion on acquisitions. So, what was the result of that billion-dollar shopping spree? Well, today, the entire company, the whole thing, is worth about $1 billion. Just let that sink in for a second. They took $1 billion of shareholder money and basically just set it on fire. It's a textbook case of value destruction. The Regis disaster is just wow. It's a perfect example of what not to do. And it leads us right into our next big topic, predictability. We need to figure out how to spot businesses that are just naturally less risky just by their very nature, by how they're built. The secret sauce here, it's all about recurring revenue. Let's do a quick comparison. Imagine a home builder. They sell you a house once, and that's it. In fact, every house they built before is now competing against the new ones they're trying to sell. Now compare that to a company like Becton Dickinson. They make disposable medical syringes. Every single one they sold last year was used and then thrown away. That creates this constant, predictable need for more. See the difference? One business is always fighting its own past success, while the other has a built-in engine for future demand. That's what creates stability. All right, we have covered a ton of ground here. So let's try to pull this all together. Let's distill it down to a simple, actionable checklist that you can actually use to go out and spot these high-quality companies. So here it is, the quality wish list. Now pay close attention to the 2 items at the top. They're marked non-negotiable for a reason. A business has to have a sustainable competitive advantage, and it has to have great management. End of story. The other things on the list, yeah, they're super important. And you might find a fantastic company that's a little weak on one of them, but makes up for it somewhere else. But those first 2, those are the deal breakers. You just can't compromise on them. And that brings us to the end. I want to leave you with a final thought. A question, really. Start looking at the world around you with this new quality filter on. Think about the companies you interact with every single day, the stuff you buy, the services you use. Ask yourself, which of these businesses would actually pass this quality test? I think you might be surprised by what you find. All right, let's talk about the G in investing. We're talking about growth. You know, it's really the engine that powers just about every great stock story out there, but it's also, honestly, one of the most misunderstood concepts. So today, we're going to break it all down. We're going to figure out where real, sustainable growth actually comes from so you can spot the difference between a future winner and a value trap just waiting to spring. Let's dive in. You know, you just have to start with this quote from Warren Buffett. It's brilliant. For way too long, investors have been taught to think of growth and value as these 2 completely separate, almost warring camps. But Buffett, of course, he got it. He knew they're deeply connected. They're joined at the hip. I mean, think about it. You can't possibly figure out the true value of a business without forecasting its future growth. It's impossible. And that idea leads us straight into a problem that every single value investor absolutely dreads. It's that nightmare scenario. You do your research, you find a stock that looks just dirt cheap, a real bargain. So you buy it, and you wait some more, and nothing. The stock just sits there, stubbornly undervalued for years and years. Your investment becomes dead money. That, right there, is the classic value trap, and it's the price you pay for ignoring the letter G. Okay, so here's our game plan for this explainer. First, we're going to really pick apart that dead money problem. Then, I'm going to introduce you to a really powerful framework for thinking about this stuff, the growth pyramid. From there, we'll work our way down level by level, starting with the top-line revenue engines, then digging into the bottom-line boosters like margins and buybacks. We've even got a pretty surprising twist when we get to the power of dividends, and then at the end, we'll tie it all together so you can analyze any company's real growth engines for yourself. So, how exactly does growth solve this whole dead money issue? Well, it's actually pretty simple when you think about it. Growth literally pays you to wait for the rest of the market to catch up and see the value that you already saw. And the way it does this, well, it's incredibly powerful. I love this metaphor. Think of a company's valuation, its price-to-earnings ratio, or PE. Think of it like a giant spring. You've got the E for earnings pushing up from the bottom, and the P for the stock price pushing down from the top. Now, as the company's earnings grow, that bottom plate starts pushing up with more and more force. So even if the stock price doesn't move an inch, that spring is getting more and more compressed. That's potential energy, its intrinsic value just building and building, waiting for the market to finally wake up and let it release. Let's put some actual numbers to this so you can see how it works. Okay, look at year 0. You buy a stock for $15 and it's earning $1 per share. Simple enough, that's a PE of 15. Now, let's jump forward 5 years. The company did great. Its earnings doubled to $2 per share. But the market got more pessimistic. The PE ratio actually fell to 12. Even with that headwind, your stock is now worth $24. That's a 10% annual return. Not bad. But here's the kicker. If that company also paid you a 5% dividend the whole time, your total return jumps to an awesome 15% per year. That's the magic of growth. It's so powerful it can deliver fantastic returns, even when the market's mood sours. Okay, so we've established that growth is absolutely crucial. But where does it actually come from? I mean, how do we deconstruct it? For that, we need a blueprint. And that blueprint is the growth pyramid. And here it is. This inverted pyramid is going to be our map. It shows us exactly how value flows through a company. See how it starts at the top, the widest part with revenues? Then it flows down through net income and free cash flow, getting more concentrated, all the way to the very bottom, the per-share results that we as investors really care about. We're going to go through this level by level. So let's start at the top, with the big one, revenues. Growing your top line is the most natural, the most organic way for a company to grow. It really is the fuel for everything else that follows. But how do they actually do it? Well, companies basically have 4 main paths they can take. The most obvious one is just to sell more of what they've already got to their existing customers or find new ones. Second, they can expand into totally new markets. That could be new countries, or it could be launching new products, kind of like how Apple went from just a computer company to this personal electronics behemoth. Third, if you've got a strong brand, you might be able to raise prices, but you got to be careful because that can attract competition. And then there's the fourth one, and it's a little counterintuitive. You can actually lower prices. The early wireless industry did this perfectly. They made cell phones affordable for everyone, and in the process, created a gigantic new market. Okay, let's move down the pyramid. Growing revenue is fantastic, but the really smart companies find ways to make their profits grow even faster than their sales. And that's where these bottom-line boosters, things like improving profit margins and buying back stock, come into play. But before we go any further, we need a huge word of warning here from the legendary investor Jeremy Grantham. He says that high profit margins are one of the least sustainable things in all of finance. And it makes sense, right? Think of huge profits like a bright light in the darkness. It's just going to attract a swarm of competitors who want a piece of that pie. That's capitalism at its core, always trying to pull those exceptional profits back down to average. And these two cases really hammer that point home. On one side, you've got Walmart. I mean, they're a textbook case of hyper-efficiency. But their net margins? They're only about 3.5%. Why so low? Because in the cutthroat world of retail, they have to pass all those savings on to us, the customers. Then you have the other side of the coin, the danger of short-sighted cost-cutting. When Tyco bought a medical device company, they just slashed the R&D budget to make their short-term profit numbers look good. Well, that left the door wide open for their competitor, Becton Dickinson, to launch a new product and just completely take over the market. It's a really stark reminder that while cutting costs can help, there are limits, and if you do it recklessly, you can literally destroy the future of the company.
All right, let's talk about the other big bottom line booster, stock buybacks. You hear about these all the time. It's when a company uses its own cash to buy its shares back from the market. This reduces the number of shares out there, which boosts the earnings per share. But the big question is this always a good thing?
So before you start cheering a buyback announcement, you really need to put on your detective hat and ask these 4 questions. First, and this is the most important one, is the stock actually cheap? Buying back an overvalued stock is like taking a pile of shareholder cash and just lighting it on fire. Second, what's management's real motivation? Are they genuinely trying to create long-term value, or are they just trying to fudge the numbers to hit an earnings per share target so they can get a bigger bonus? Third, are they borrowing money to do it? Because that's just adding risk to the business. And finally, you have to ask, is there a better use for this cash? Like, could they be investing in a new product or maybe paying a dividend? You know, that last question on our checklist, is there a better use for the cash, is the perfect segue to the final piece of our pyramid, dividends. And this is where we're going to take a piece of conventional wisdom that, honestly, most investors just take for granted, and we're going to flip it on its head. So, the conventional wisdom says yes, right? It seems totally logical. If a company is sending a big chunk of its earnings out the door to shareholders as dividends, well, that's just less money left over to reinvest in growing the business. It makes sense on the surface. But what if I told you that when you look at the historical data, the evidence actually suggests the exact opposite can be true? It is one of the most counterintuitive, but also one of the most powerful findings in all of finance. So there was this landmark study back in 2003 by Cliff Asness and Robert Arnott. And what they found was that historically, companies with higher dividend payout ratios, the ones giving more money back to shareholders, actually had faster future earnings growth. So what on earth is going on there? The secret ingredient is management discipline. See, when a company commits to paying a steady dividend, management knows they can't afford to waste a single penny of the cash they keep. Every single retained dollar has to be invested as wisely as possible. It basically prevents them from wasting money on dumb acquisitions or corporate jets. Wharton professor Jeremy Siegel has just a beautiful way of phrasing this. He calls dividends bear market protectors and return accelerators. Think about it. During a bear market, reinvesting those steady dividend checks lets you buy more shares when they're cheap, which protects you on the way down. Then, when the market finally turns around and recovers, all those extra shares you bought act as a powerful return accelerator, juicing your gains on the way back up. Whew! Okay, so we have traveled all the way from the top of the growth pyramid to the very bottom. We've seen how companies can grow revenues, boost their margins, buy back stock, and pay out dividends. Now, it's time to put it all together. So, let's wrap this up. What are the big takeaways? First, and this is huge, don't ever be fooled by a company's past growth rate. Don't just draw a straight line into the future. Instead, use this growth pyramid as your tool. Break down where that growth is really coming from, level by level. And finally, remember that the strongest, most resilient companies, they're like a rocket with multiple engines. They have different ways to grow. That way, if one of their engines starts to sputter, the others can keep the whole thing driving forward. And that really brings us to our final thought. I want to leave you with a question to take with you and apply to your own investments. Go look at the companies you own. Go beyond the headline earnings number and ask yourself this: what are the true underlying growth engines of this business? And even more importantly, are they built to last? Thanks for watching. So let's start with a huge question. What's a company really worth? I'm not talking about its stock price today, but its true deep down intrinsic value. You know, it's probably the biggest question in investing. And getting it right, well, that can be the difference between making a fantastic decision and a really, really costly mistake.
So here's what we're going to do. We're going to crack open the investor's toolbox. First, we'll look at the simple but super popular hammer of relative valuation. Then we'll get into the more complex blueprint of absolute valuation. We'll see how to make them work together. And finally, how to use all this stuff to get through a tricky sideways market.
Okay, let's kick things off with a really core idea. Thinking about valuation isn't some rigid science with one magic formula. Nope, it's much more like a craft, and any good craftsperson needs a full set of tools to do the job right. I mean, imagine a carpenter showing up to build a house with only a hammer. It sounds ridiculous, right? They'd be totally unprepared. Well, it's exactly the same for an investor who only relies on one method to figure out what a company's worth. You need the whole kit. In this quote, man, it just hits the nail on the head. You might have a favorite tool, right? One that's quick, easy, gets the job done most of the time. But a real pro knows that the best results come from using different tools together, knowing each one has its own strengths and its own weaknesses. All right, let's grab our first tool from the box, and it's the one you've almost certainly heard of. This is the hammer of the investing world, relative valuation. It's popular for a reason, but as we're about to see, it can also be used to hit your own thumb if you're not careful. So what is it really? Well, at its core, relative valuation is just all about comparison. It asks a simple question. How does this company's price stack up against its competitors, or even against its own past? And the most common way to do this is with the price-to-earnings ratio, or PE. It's everywhere because it's so simple to calculate and easy to grasp. So how do people actually put this PE ratio to work? Well, first, they'll compare a company's PE to its direct rivals to see if it looks cheap or expensive. Then they might check it against the whole industry average to get a bigger picture. They'll also look at its own history. Is it trading higher or lower than it normally does? When you put it all together, the PE ratio gives you this quick snapshot of how the market is currently voting on that stock. But, and this is a big but, here's the problem with only using the hammer. The past is not always a roadmap for the future. That crazy high valuation a company had during a bull market, it might not ever come back. Its growth could slow down, its entire industry could get turned upside down. A past PE is just one clue. It is not a guarantee. And this leads to what the source material calls the relative valuation trap. This is where an investor buys a stock at, say, 20 times earnings, because they assume it's going to get back to the 45 times earnings it hit a few years ago. But what if the market has changed? What if the world has changed? That kind of thinking can lead you right off a cliff. So if the hammer isn't enough, we need to pull out a more detailed tool from our toolbox. It's time for the blueprint, absolute valuation. This is all about figuring out a company's true intrinsic worth, totally independent of what the market is screaming about right now. The main method here is called discounted cash flow analysis, or DCF for short. Now, the idea is actually pretty simple. A business is worth all the cash it's going to generate for its owners over its entire life. So a DCF model tries to forecast all that future cash, and then it does a little math to figure out what that whole stream of cash is worth in today's dollars. But here's the catch, and it's a big one. DCF models are incredibly sensitive. You change your forecast for sales growth or profit margins just a tiny bit, and your final valuation can swing like crazy. That's why the goal isn't to get some pinpoint precise number. It's about being generally in the right ballpark. Or, as the great saying goes, it's better to be vaguely right than precisely wrong. This slide just puts our two tools in perfect contrast. Think of it this way. The hammer on the left is simple and it looks backwards. It tells you the market's current opinion. The blue point on the right is complex and it looks forward. It helps you form your own opinion of what a company is really worth. They're not just different tools, they're two fundamentally different ways of seeing the world. So which one's better, the hammer or the blueprint? Well, you know what? That's the wrong question. The real skill of a master isn't picking a favorite tool. It's knowing how to use both of them together to get a complete three-dimensional picture of what's going on. So here's how it works in the real world. You can start with that relative valuation hammer. You see a company is trading at a discount to its peers. The crucial next step isn't just to buy it, it's to ask why. Then you pull out the blueprint and build your DCF model, running different scenarios, a good one, a bad one, and an ugly one. The clues you got from your relative analysis can help you figure out which of those scenarios is most realistic, helping you narrow down your valuation range and get a heck of a lot closer to the company's true worth. All right, theory is great, but let's make this real with an example. A company like eBay is the perfect candidate for this combined approach because, well, it's not just one business. It's a few different businesses all living under one roof, and each one has very different characteristics. And this table just brilliantly shows why you need the whole toolbox. You can't just slap one PE ratio on the whole company. The core marketplace's business, slower growing, so you'd use a lower PE. But PayPal, That was a high-growth engine with a huge competitive advantage. It deserves a much higher PE. And you might even want to look at a price-to-sales ratio. See? Each part needs its own specific tool from the box. And after you valued all the individual businesses, there's one last crucial step that people forget all the time. You have to add the net cash that's sitting on the balance sheet. In eBay's case back then, that was another $5 billion of value just sitting there, plain as day. Okay, now let's apply these tools to a really specific and frankly, really tough environment. A sideways market, where the overall stock market isn't going up or down, it's just turning. In markets like these, valuation becomes absolutely critical. If we look back at the long sideways market from 1966 to 1982, history gives us a pretty stark warning. During that whole time, stocks with high PE ratios, the darlings, the growth stocks, were basically toxic. Why? Because as everyone's excitement faded, those super high PE ratios got crushed, and even if the company's earnings grew, it just couldn't make up for that damage. And this chart just visualizes that damage perfectly. The source material found that over that whole 16-year slog, the lowest PE stocks consistently beat the highest PE stocks, often by a margin of 2 to 1. They just had less air that could come out of their valuation balloons, so to speak. So, the crucial question is, how do you protect yourself? You do it with the most important piece of protective gear in your entire toolbox, a margin of safety. This is simply the gap between the intrinsic value you calculated with your blueprint and the price you actually pay in the market. It's your buffer. It's your cushion for when you're wrong because, let's face it, we all are sometimes. And this all brings us to maybe the most famous quote in all of investing, from the godfather of value investing himself, Benjamin Graham. It just perfectly wraps up everything we've been talking about. Price is that number flickering on a screen every second. Value is something much deeper. Something you have to carefully figure out for yourself. And that leaves us with a final thought for you to take away. As you look at your own investments, or even just think about the market in general, ask yourself this one simple question. Are you just reacting to the constant noise of changing prices, or are you taking the time to open the toolbox and figure out the true underlying value?
Welcome to The Explainer. Today, we're going to break down a really powerful framework for looking at any stock. It's called QVG. And it stands for quality, valuation, and growth. We're going to explore why falling in love with just one of these is pretty much a recipe for disaster, and how finding that right balance is really the secret to smarter investing. Okay, so let's just dive right into the central question, right? When you're looking at a stock, can you really afford to just ignore one of these key areas? Is a great company always a great stock? Is a cheap stock always a bargain? Well, we are about to find out.
All right, so here's how we're going to tackle this. First, we'll lay out the basics of the QVG framework itself. Then, we'll get into the fun stuff, what happens when investors get it wrong and focus on just one of these pillars. After that, we'll expose this really dangerous religion stock trap, and then we'll wrap it all up with the investor's golden rule. So here's the crucial point. Any stock at all, can be analyzed through these 3 distinct lenses: its fundamental quality as a business, its current valuation out there in the market, and its future prospects for growth. You should think of them as the 3 legs of a stool. If one is weak or wobbly, the whole thing can just topple over.
So let's really break down what each pillar is asking. Quality is all about the business itself. Does it have some kind of lasting competitive advantage? A high return on capital? How efficiently does it use its money to make more money? Then there's valuation, which asks a simple question. Is the stock cheap or is it expensive? This is where you look for a margin of safety, which is just a fancy way of saying you're buying something for less than it's really worth. And finally, growth looks to the future. Is this company going to get bigger, more profitable? The real key isn't finding a perfect 10 in one category. It's understanding how all 3 of them work together.
Okay, so now let's see what happens when investors get tunnel vision and just fixate on one of these things. As you're about to see from some real-world examples, a one-dimensional view, well, it's often a recipe for failing. First up is the trap that snares so many people. Falling head over heels for a high-quality company that's just way too expensive and isn't really growing. It feels safe, it feels smart, but man, it can be a surprisingly common and painful trap to fall into.
A perfect case study is H.J. Heinz back in 1998. It was the absolute definition of a high-quality company. But just look at the numbers. It was trading at 23 times its earnings, and it had very little room to grow. It already owned the catch-up market. So what happened? For 12 years, the stock price went absolutely nowhere.
This is such a classic example of how a fantastic business can be a truly terrible investment if you pay too much and the growth just isn't there.
Okay, the next trap is that tempting siren song of the cheap stock. It looks like a total bargain on the surface, but it's often what investors call a value trap. You think you're getting a steal, but what you're really doing is trying to catch a falling knife.
And General Motors is a perfect example here. For decades, it always looked cheap on paper, always trading at this low price-to-earnings ratio. So why did people buy it? Well, often for the dividend, or just simple faith in this great American icon. But the business itself was just deteriorating. It was losing market share, it was plagued by all these internal problems. See, for a low-quality business, time is your enemy. The problems underneath just get worse and worse. And GM proved that cheap can stay cheap for years and years, before eventually just heading to zero. That low valuation, it wasn't an opportunity, it was a huge warning sign. And that brings us to the most exciting, and maybe the most dangerous, trap of all. The high-growth, high-valuation, low-quality company. These are the stocks that get all the headlines, but their foundations, well, they could be built on sand.
Yeah, we're talking about the dot-com bust. These companies had incredible, unbelievable revenue growth, but their valuations were just astronomical, and most of them had no real competitive advantage, in other words, zero quality. So when that hype bubble finally burst, it was a really harsh lesson. Explosive growth means absolutely nothing if the company isn't built to last, and the price is completely detached from reality.
You know, as Bill Gates so wisely pointed out, early success, or even just the illusion of fast growth, can create this really dangerous sense of invincibility. It convinces smart investors to ignore glaring flaws in quality and valuation, and it just seduces them into thinking they can't possibly lose.
Okay, so you might be thinking, all right, 1 out of 3 is bad, I get it. But what if a stock scores high in 2 of these areas? And yeah, that's definitely much better, but as we're about to see, even a 2 out of 3 approach isn't a guarantee. It can still lead you right into trouble if you're not careful. So, what if you find a high-quality company at a cheap price, but its growth is totally stalled out? Well, in this case, time is not on your side. With no growth to push the stock up, you really need 2 things. First, you need a much deeper discount, a true bargain that gives you a huge margin of safety. And second, you need to be able to identify some specific catalyst, an event like a merger or a big restructuring that's going to force the market to see the company differently and unlock its hidden value.
Now, this scenario, a cheap, growing company that has some kind of quality flaw, a lot of people would argue this is the most dangerous combination of them all. A really serious flaw, like way too much debt, can be fatal. The only exception is if that specific flaw is balanced out by some other strength. For example, teen fashion retailers. They have this built-in quality flaw of fad risk, right? What's cool today is gone tomorrow. They make up for this by having these rock-solid balance sheets with tons of cash and very little debt.
Now let's dive into the most common, and maybe the most seductive, 2 out of 3 trap. The combination of high quality and high growth, but at a truly terrible valuation. This, my friends, is where we find the religion stock.
So, what on earth is a religion stock? Well, it's actually pretty simple. It's a great company that everyone knows, everyone loves, and it has this long history of just knocking it out of the park. The problem is, investors admire it so much that they completely replace objective analysis with just unquestioning faith. They become willing to pay literally any price for it, and that's where the danger is.
And this is basically how a stock achieves sainthood. It starts with a long history of great performance. Then, investors make a crucial mistake. They just assume the past guarantees the future. Cautious analysis gets thrown out the window and is replaced by loud cheerleading. And eventually, faith completely takes over from fact. The stock just becomes a one-decision buy, no matter how ridiculously high the price gets.
If you want the poster child for a religion stock, you have to look no further than Coca-Cola in the late 90s. It was an incredible company, a world-class brand, and it had delivered amazing performance for decades. It was really hard not to admire it.
But that admiration, it rose to completely irrational levels. At its absolute peak, investors were paying nearly 50 times its annual earnings for the stock. Just think about that. That valuation was pricing in growth expectations that were simply impossible for a mature company of its size to ever meet. You know, it's like that great Yogi Berra line, "The future ain't what it used to be." No company, it doesn't matter how great it is, can grow at a super fast pace forever. Eventually, old age catches up, growth slows down, and reality sets in. For Coca-Cola, that meant its famous double-digit growth rate was cut in half over the next decade. And here's the crucial point.
The biggest risk in these stocks is hidden. It's not a question of if that sky-high PE ratio will come back down to earth, it's only a question of when. GE was another classic case where faith led investors to just ignore how complex the company was until it was way too late. That false sense of safety these stocks provide, it comes at the enormous cost of future underperformance.
So after looking at all these different traps, what's the golden rule here? What's the big takeaway? Let's put it all together in this final section.
You know, after exploring all of these scenarios, the conclusion from this framework is emphatic and it's simple. Do not compromise on more than one dimension. A stock that is weak in two or more of these areas just introduces way too much risk for far too little potential reward.
Here's the best way to think about their roles. Valuation and growth, those are your engines. They are what actually drive your returns. And quality, that's your insurance policy. It's the factor that makes sure the company is strong enough to survive and actually be around long enough to deliver those returns to you. So we'll leave you with this final thought to chew on. Take this QVG framework and apply it to your own investments. Look at each one and ask yourself honestly, which stocks did you buy based on a real analysis of all three of these pillars, and which ones are you maybe just holding on to based on little more than faith?
Welcome to The Explainer. Today we're going to talk about something that drives a lot of investors absolutely crazy. A market that's just stuck. You know, it's volatile, it's choppy, but at the end of the day, it feels like it's going nowhere. We're going to break down a strategy for not just surviving this kind of market, but actually using it to your advantage. The whole idea? Think like a long-term owner, but act with short-term precision. Okay, so here's the game plan. We're going to start by taking a hard look at a classic piece of investing advice that might be holding you back. Then, we'll completely reframe how you think about volatility. It's not the enemy. After that, we'll shift our focus from timing the whole market to timing individual stocks. And yes, there's a huge difference. Finally, we'll give you a practical toolkit and the right mindset to actually pull this all off.
All right, first up, let's talk about buy and hold. You've heard it a million times, right? It's treated like gospel. But if you feel like your portfolio has been stuck in the mud lately, this is probably why. We need to really understand why this classic strategy might be failing you right now.
So, does this feel familiar? You look at your portfolio, you see all these ups and downs, but no real growth. It's frustrating. If that's you, you are definitely not alone. And the reason often has less to do with the companies you picked and everything to do with the kind of market we're in.
Okay, this slide paints a really clear picture. In a roaring bull market, everything's great. Investor sentiment is high, PE ratios expand, and pretty much everything goes up. Buy and hold is a fantastic strategy here. But a sideways market, that's a whole different animal. Valuations just kind of yo-yo around an average. You get this wild ride, but you often end up right back where you started. And a passive buy and hold approach just gets you nowhere.
And this is really the heart of the problem, isn't it? Buy and hold often just becomes a code name for buy and forget to sell. We spend all this time researching what to buy, but we don't really have a plan for when to sell. Now, that's okay when the market's on a one-way trip up, but it is a huge, huge liability when things are just moving sideways. We have to get more active about both buying and selling.
So this leads us to a really fascinating twist. The very thing that makes these sideways markets so frustrating, you know, that constant nerve-wracking volatility, that is actually your single greatest opportunity, if you know how to look at it.
You have to learn to make friends with volatility. That means you respect its power for sure, but you also use it to your advantage. But, and listen, this is absolutely critical. This does not mean you should start trying to predict where the entire stock market is going next. That is a completely different and frankly a much more dangerous game.
Look, trying to time the market is basically a fool's errand. You have to be right twice when you buy and when you sell, and you're fighting against raw emotion the whole time. The source gives us a perfect example. Think back to the summer of 2007. The housing bubble was bursting, credit markets were seizing up. Logically, the market should have tanked. But what happened? The Dow Jones actually went on to hit an all-time high. It just ignored all the warning signs for months.
And you know, this is such a critical trap to avoid. The absolute worst thing that can happen to someone trying to time the market is getting lucky once. You'll think you've cracked the code, that you're a genius, when really it was just random chance. And that one lucky guess can lead to a ton of future losses, because you start thinking you have a skill you don't actually possess.
Okay, so if timing the market is out, what do we do instead? We stop trying to predict the unpredictable.
We just completely shift our focus. We go from looking at the big, chaotic, macro picture of the market to the small, micro picture of individual companies. I love this old Milton Berle quote because it just hits the nail on the head. It perfectly captures that feeling of exhaustion from trying to guess what the market's going to do next. You can drive yourself crazy and broke trying to be a bull one day and a bear the next. The solution? Just stop playing that game entirely.
And this is the big idea. This is the fundamental mindset shift. We stop trying to time stock prices, and we start timing stock valuations. The source calls it pricing stocks, not predicting them. See, we're not trying to guess if a stock is going up tomorrow. We're trying to figure out its real fundamental value today, and then we just wait and act when the market's price gets way out of line with that value.
Okay, that all sounds great in theory, right? But how do you actually do it? Well, our source gives us this awesome three-dimensional framework, a toolkit you can use to price individual stocks and make smart, rational decisions.
It all boils down to a very simple two-question test, and you have to ask them in this order. First, is this a good company? That's where you look at its quality, like does it have a competitive moat, and its future growth prospects. Only if it passes that test do you move on to question 2. Is this a good stock? And that question is purely about one thing: its valuation at today's price.
So what happens when you find a fantastic company but the stock is just way too expensive? Simple. It goes on your wish list. This is such a brilliant tool. It means all your hard research doesn't go to waste. It frees you from that emotional pull of wanting to own a great company right now. It turns a no into a not yet.
And here's how it all comes together. 1. You analyze companies using that quality, valuation, and growth lens. 2. The great ones that are too pricey, they go on your wish list. 3. And this is the tough one. You patiently wait for your price. And 4. When the market finally serves it up, you buy.
So we've got the process down, but now we come to what the source says is by far the hardest part of this entire strategy. It's not the math, it's not the research, it's having the mental strength and the discipline to just wait. This quote from Blaise Pascal is about life, but man, does it apply to investing. In our world, it means being able to sit on your hands, to fight that constant urge to do something, especially when the news is crazy and prices are flying all over the place. It means having the strength to do absolutely nothing until a truly great opportunity lands in your lap.
To really make this idea stick, the source tells this wonderful little story from the world of Tevye the Milkman. It's about a farmer at a livestock auction, and it just perfectly illustrates this whole idea of disciplined patience. You see, Tevye went to the auction with a crystal clear idea of the quality he was looking for. He knew his ideal cow, he called her Goldie, and he knew exactly the price he was willing to pay. He watched other farmers get all caught up in the excitement, overpaying for so-so cows. But Tevye, he refused to settle, even when his wife gave him a hard time for coming home empty-handed. And that is the crucial takeaway, isn't it? Tevye wasn't being lazy or indecisive. His inaction was an active, deliberate, and very well-informed choice to wait for his opportunity. Doing nothing, when you know exactly why you're doing it, is an incredibly powerful action. And if you think this is just some cute, folksy story, think again. This is literally how some of the world's greatest investors operate. Warren Buffett lives by this philosophy. You don't get points for being busy, you only get points for being right. And if that means you have to wait indefinitely for the right pitch to come along, then that's what you do.
Okay, let's get to our final section, and let's redefine what doing nothing really means. Because it's not about sitting around playing bridge, unless you're Warren Buffett. For the rest of us, this do-nothing time is actually mission-critical prep time. It's when you get ready for battle.
This is how you turn waiting into a massive advantage. You use the market's quiet times to do the hard work. You expand your knowledge. You research new companies. You build and constantly refine that wish list. You are always preparing, so that when the market's volatility finally serves up one of your companies at your price, you don't even have to think. You strike with absolute confidence because you've already done all the homework.
So there you have it, a new framework, a whole new way to look at a frustrating, sideways market and see it as a field of opportunity. The strategy itself is simple, but as we've seen, it is definitely not easy. The real question is, what are you going to do with your time now? Because learning to wait is only half the battle. Are you prepared to do the work, to build your list, and to be ready to strike when your moment finally arrives?
You know, in today's market, the old playbook for value investing, it might not be enough. So today, we're diving into this idea of the born-again value investor. It's someone who has to completely rethink their approach just to survive and thrive. So what does that actually mean? Okay, let's get right to the heart of it. Forget about hot stock tips, forget about chasing the latest guru. The source material we're digging into today makes one thing crystal clear. The only real, sustainable way to succeed in investing is to learn how to think for yourself. And yeah, that's the million-dollar question, isn't it? It's one thing to say, think for yourself. But how do you actually do that when you're being bombarded 24/7 with news, opinions, and expert analysis all screaming for your attention? That's the challenge we're going to tackle. To really frame this challenge, let's use a powerful metaphor. Think about your journey as an investor as being kind of like Odysseus's epic voyage home. It's long, it's hard, and it is absolutely filled with temptations that can pull you way, way off course. And this slide, wow, it just lays out the two versions of ourselves perfectly. We all want to be that person on the left, right? The calm, rational investor with a long-term plan. But the constant noise of the market, it can twist us into that person on the right, the frenzied, emotional trader who's reacting to every little blip on the screen. And that is the transformation we have to fight against with everything we've got. So what's the biggest danger on this voyage? Well, let's call it the siren song of noise. You know, like the sirens in the Odyssey. It's the seductive pull of the crowd, this feeling that if everyone is doing something, it must be right. But as we're about to see, following that song can be an incredibly dangerous trap. I love this Oscar Wilde quote because it just nails the kind of contrarian mindset we need to build. It's not about just being different for the sake of being different. It's about using popular opinion as a red flag, a signal to stop, take a breath, and really question what's going on. All right, let me tell you a story. It's a classic, a real cautionary tale from the dot-com bubble. Back in the late 90s, the crowd was head over heels in love with Sun Microsystems. It was the stock to own. Everybody was piling in, and the price just kept climbing. And this is where it gets absolutely wild. The company's own CEO, Scott McNealy, was basically out there screaming that the price was insane. He laid out the math for everyone. He said, look, for this price to make any sense, we'd have to give you every single penny of our sales, not profit, sales, for 10 years straight. It was mathematically impossible, and he said so, but the crowd just kept on buying. So did anyone listen? Nope. In 2000, fueled by pure hype and ignoring all logic, the crowd jammed that stock price all the way up to its absolute peak, a staggering $64 a share. This was the siren song at full volume. And then, reality hit. Hard. Fast forward 9 years, the bubble's long gone, and Sun gets acquired by Oracle for just $9.50 a share. A total catastrophic collapse. It is the perfect, brutal example of what happens when you follow the herd right off a cliff. Okay, so that's the danger. It's real. So how do we fight it? How do we survive? Well, going back to our Odyssey metaphor, the answer isn't just to grit your teeth and endure the noise. It's about proactively finding ways to plug your ears. First, we have to identify the source of the noise. And the source material gives it this perfect name, business entertainment. It looks like news, it sounds like news, but it's not. It's a show designed to explain random, unexplainable market wiggles with flashy graphics and confident experts. It doesn't create knowledge, it creates anxiety. And that is pure poison for a long-term investor. And this analogy just hits the nail on the head. Imagine turning on your TV and seeing a 24/7 channel with experts predicting and then analyzing why the roulette ball landed on red 17. You'd think it was completely insane, right? Well, that is exactly what business entertainment does with the market's day-to-day randomness. So what do you actually do about it? Here it is, a simple 3-step media diet. Step 1, and this is the big one, just turn it off. Seriously. Step 2, replace that noise with actual substance, long-form interviews, deep dives, things that make you think. And step 3, realize this is an active fight. You have to constantly guard your own mind. All right, tool number 2 for plugging your ears is huge, and it's all about realizing one simple truth. You are not Julius Caesar. We all love to think we can multitask, but the science says not so much. In fact, a Stanford study found something fascinating. People who are heavy multitaskers, They're actually worse at filtering out irrelevant information. Just think about that for a second. As an investor, your entire job is to filter out the noise. Multitasking literally damages your most important skill, while single-tasking, just focusing deeply on one thing at a time, is what makes real, rational analysis possible. And this George Bernard Shaw quote is just perfect, isn't it? It's a witty way of saying that real, honest-to-goodness thinking is actually a rare and valuable thing. You have to carve out time for it. You have to create the quiet space for it to happen. It's not going to happen with 10 browser tabs open and a TV blaring in the background. So, how do you practice this kind of deep thinking? The source suggests a super powerful tool. Write. Just write. Think of all the information in your head as this big, messy Caesar salad. Writing forces you to sort through it all and pick out the croutons, the actual, solid, concrete ideas. It transforms you from a passive consumer of information into an active thinker. Okay, let's tie all of this together. We've identified the dangers, we've talked about the tools, so now let's lay out the timeless principles, the navigational charts that will keep you on course during your own personal odyssey. Here they are, the core rules for the independent thinker. First, know what you don't know. Stay in your lane, stick to what you actually understand. Second, use what's called time arbitrage. Basically, your patience is your superpower. While everyone else is freaking out about the next quarter, you can focus on the next 5 years. Third, create a paper trail. Write down why you're making an investment. It'll be your rational anchor when emotions get crazy. And finally, remember, you don't have to own everything. Resisting the fear of missing out, resisting FOMO, is maybe the most valuable skill of all. So we end with this question for you. The sirens of the market will always be singing their songs of hype and fear. That's never going to change. So the question is, what are you going to be? Are you going to be just another sailor getting tossed around by every wave and every rumor? Or are you going to be the captain of your own ship, with your ears plugged to the noise and your eyes fixed firmly on your own destination? The choice is yours. Let's talk about one of the single most overlooked and, frankly, misunderstood skills in all of investing: knowing when to sell. You know, in a world that just screams buy and hold, the very act of selling a stock can feel like you're doing something wrong, like it's a sin. But what if I told you that selling, when done correctly, is actually the key to better returns in a much healthier portfolio? Well, let's find out. So here's what we're going to cover. First, we'll break down this whole buy and hold religion. Then we'll get into the psychology of it all, the mental traps that make selling so dang hard. After that, we're going to introduce a really cool Darwinian framework for your portfolio, give you a practical rule book for selling, and wrap it all up with a mental model to help you make those tough calls without all the emotional baggage. All right, first up, why on earth does selling have such a bad rap, especially when the market's just soaring? It's true, isn't it? When stock prices are just climbing and climbing and everyone feels like an investing genius, the very idea of selling is basically heresy. Buy and hold becomes this unquestioned belief system, a kind of investing church. And in this church, selling is breaking the most sacred rule. If you sell, you're not a believer, you're just a trader. But, just holding a stock because you bought it, that's a huge mistake. You should only hold it if its future really justifies it. And what's really fascinating is who's been held up as the god of this buy and hold church: Warren Buffett. The perception is he's the ultimate buy and hold forever guy, right? But the reality, well, it's a bit more complicated. Buffett became a buy and hold investor mostly because his portfolio got so gigantic that selling became a huge logistical problem. But back in his early days, when he was more nimble, he was a very active buy and sell investor. But look, it isn't just market dogma that keeps us from selling. So often, it's our own brains working against us, setting these emotional traps that can end up costing us a ton of money. It really is a simple question, but the answer is anything but. The truth is, we get emotionally attached to our stocks. I mean, think about it. All the time we spend researching them, watching them, parting with them, whether they're winners or losers, it becomes this intense psychological battle. And these emotions, they attack us from two different directions. So with a stock that's losing money, we fall into what's called the loser's trap. We get anchored to the price we paid, and all we can think is, I just want to break even if the company's prospects are terrible. But then with a winning stock, we fall into the winner's trap. We get greedy, we want to squeeze out every last drop and sell at the absolute tippy top. A point, by the way, that you can only ever see in the rearview mirror. So this brings us to a much more powerful way of thinking about your portfolio. Instead of treating it like some museum of your past decisions, what if we started treating it like an ecosystem, governed by survival of the fittest? And that's the core idea right there, portfolio Darwinism. It's not about being emotionally attached. It's a logical, disciplined process. You're constantly curating your portfolio, always weeding out the weakest links to make room for stronger, better opportunities. And this doesn't just improve your potential returns, it actually makes your entire portfolio less risky over time. So how does this weeding process actually work? Well, there are really two main triggers. First, the valuation deteriorates. Now, this is a good problem to have, right? It means your stock went up. But as that price climbs, your margin of safety, that cushion you had, starts to shrink. The second trigger is when the fundamentals deteriorate. This is the bad one. This means the company itself is having problems. Its quality, its growth, something's getting worse, making it a much riskier bet than when you first bought it. Okay, so the theory sounds solid, but to actually put this Darwinian idea into practice, you need a system. You need a clear, unemotional rulebook for selling. I absolutely love this quote from Bernard Baruch because it just flips the whole script. It's a reminder that the goal isn't to perfectly time the top of the market. The real goal is to sell with discipline, to lock in your profits, and to manage your risk. Honestly, selling too soon is almost always more profitable than holding on too long. So here's the most powerful tool for taking your emotions out of the picture. You decide on your exit plan before you even buy the stock. That's when you're at your most rational, your most objective. By setting a specific selling price, or even better, a target valuation like a certain PE ratio, the future decision basically makes itself. The sell trigger is already loaded. Now, for handling those deteriorating fundamentals, here's a brilliant analogy, the stock prenup. Think about it this way. You marry your stocks, right? You're hoping for a long, happy life together, but you have an agreement in place just in case things go bad. First, you set the terms, you identify the key metrics that made you fall in love with the stock in the first place. Second, you monitor for breaches. Third, if the company starts to disappoint you, it goes on double secret probation. You're watching it like a hawk. And finally, if there's no improvement, well, it's time for a divorce. You sell the stock. All right, finally, let's look at one last, super powerful mental model to help you make these tough decisions. And it comes from a classic story out of Silicon Valley that just perfectly shows how to cut through all that emotional baggage we carry around. So picture this. The year is 1985, and Intel is in a full-blown crisis. Their bread and butter business, memory chips, is just getting absolutely destroyed by Japanese competitors. Profits are gone. The company's entire identity, its future, is on the line, and the leadership is just agonizing over what to do. Then, in a moment of pure genius, CEO Andy Grove turns to his co-founder, Gordon Moore, and he asks him this simple question. This little bit of reframing changed absolutely everything. It forced them to step outside of themselves, outside their own history with the company they built. And Gordon Moore's answer was instant. No hesitation. He said a new CEO, someone with zero emotional attachment to the memory chip business that built Intel, would make the cold, hard, rational choice to get out of it and pivot to the new microprocessor business. And Grove's response? Why shouldn't you and I walk out the door, come back, and do it ourselves? And that's the whole point. That one question just liberated them. It allowed them to dump years of sunk costs and emotional baggage and see the path forward clearly. A new leader wouldn't care about past decisions. They'd only look at the facts and the future. And that is exactly what Intel did. And, well, they became one of the most profitable companies in the world. And so that brings us right back to you with one final provocative question. I want you to take a hard look at your own investments. If a sharp, unemotional, objective manager took over your portfolio right now, someone with no history with your stocks, what would they sell immediately? The answer to that question might be the most valuable thing you figure out today. Have you ever had one of those days, where you feel like an investing genius, and then the very next day you feel like a complete idiot? One minute you've cracked the code, the next you've totally lost your mind. Well, guess what? You are not alone. That's psychological whiplash. That's exactly what the market is designed to do to you. So today, we're going to dive deep into why your emotions can be your own worst enemy in the stock market, and more importantly, how you can fight back. All right, here's our game plan. First, we'll get into the weeds of the market's mind games. Then, we'll talk about that awful feeling of being dumb during a downturn. After that, we'll look at the flip side, feeling like a genius when everything's going up. And finally, we're going to pull it all together with the one powerful strategy that can keep your head straight no matter what the market throws at you. You know, when it really comes down to it, investing is a battle. It's a fight between your rational brain and your emotional gut. And the market, it's constantly feeding you a diet of fear and greed, pushing you right into those classic psychological traps. You've got the fear of missing out, or FOMO, when prices are just soaring, and then there's loss aversion, that paralyzing fear when prices are falling. Winning isn't just about picking the right stocks, it's really about mastering your own mind. So, I want you to think of this explainer as your mental toolkit. This is the gear you need to fight back against the market's psychological warfare. Seriously, it's designed to arm you against that constant pressure to do the wrong thing at the absolute worst time, which, as we all know, is kind of the market's specialty. Now, this is where things get really, really tricky for investors. We're often in what's called a secular sideways market. This isn't some long, steady climb or a slow, predictable decline. No way. Think of it less like a river with a strong current and more like a choppy ocean. It just moves up and down in these violent, shorter cycles. And yeah, this creates constant opportunities to buy and sell, but every single one of those waves is also a perfectly designed emotional trap. Okay, so now that we get the choppy, emotional battlefield we're on, let's dive into how our own minds can get the best of us. And we're going to start with the most painful part, that sinking, gut-wrenching feeling of being a complete failure during a bear market. You know, when the market is just falling and falling and falling. Does this hit close to home for anyone? I mean, have you ever felt like this? It is that brutal feeling where every single decision you make seems to be the wrong one. You buy a stock, you've researched it for weeks, you are convinced it's a bargain, and it just keeps falling. It's a feeling that makes you question not just your strategy, but your own intelligence. And yep, this feeling actually has a name. It's the bear market feeling. It's this powerful illusion that your skills have just evaporated, but they haven't. What's really happening is that the recent pain of all those losses is completely overshadowing all your past successes. It makes you believe you've lost your touch. It's a total distortion of reality, but man, does it feel real. And it leads to some truly terrible decisions. And this is the danger zone. This is a downward spiral that can be incredibly hard to escape. The pain from your losses is real, and it triggers panic. Your confidence just shatters, and that human instinct to stop the pain kicks in, right? The quickest way to do that is to sell everything. So you join the herd, you sell low just like everyone else, and you retreat to the so-called safety of cash, locking in your losses right at the bottom. So how do you break the cycle? The key is to remember that investing is a long game. When the market is screaming at you, just screaming at you to focus on the pain of today, this is your reminder to zoom out. A temporary downturn, no matter how painful it feels, shouldn't derail a solid long-term strategy. Tomorrow will come, and you know what? With it comes the recovery. Okay, so we've talked about the paralyzing dangers of fear, but what about the other side of that emotional coin? Now let's look at the equally dangerous, seductive emotion of euphoria that takes over during a bull market. You know, that time when the market just keeps going up. And there it is, the Midas touch. Ever felt this? That incredible, intoxicating feeling that you just can't lose. Every single stock you pick just soars. You feel like you've finally figured it all out, like you see the market more clearly than anyone else. And you know what? It feels amazing. And that's precisely why it is so dangerous. This, my friends, is the bull market feeling. It's a classic case of a rising tide lifting all boats, including yours, and you've mistaken the tide for your own sailing genius. You haven't suddenly developed a superpower. The broad market momentum is just masking mistakes and making every single decision look brilliant. This feeling, it leads you down a very seductive but incredibly dangerous path. That golden touch feeling makes you overconfident, and then it makes you careless. You start ignoring red flags. You only see evidence that proves you're a genius. You completely forget about risk management because, hey, what's risk when you're on a hot streak? All you can see is the reward. And that's when you take the biggest gambles, often right at the peak. So the key to avoiding this trap, to keeping your feet on the ground when your portfolio is in the clouds, is to stay humble. It's a conscious, disciplined effort to remember the one thing the euphoric market wants you to forget. Risk. Risk never, ever disappears. It just gets really quiet for a little while. So here we are. We have these two opposing, super powerful psychological forces trying to wreck our portfolios. Fear on one side, euphoria on the other. How do we possibly navigate these emotional minefields? Is there a way to stay rational when it feels like everyone else is losing their minds? Well, the answer is yes, and it's simpler and way more powerful than you might think. Here it is. The key is to use your own past experiences as a weapon against the market's current mood. So when the market is making you feel dumb, you fight back by methodically reviewing your past wins. You force yourself to relive your best calls. This isn't about ego. It's about restoring the rational confidence you need to do the hard thing. Buy great companies when they're cheap. And when the market makes you feel like a genius, you do the exact opposite. You pull out the files on your past losses. You reread what went wrong. This restores the humility you need to do the other hard thing. Sell a great company when it's become fairly or even overvalued. You see, this strategy works because it forces you to completely redefine your objective. You have to abandon the fool's errand of trying to time the market perfectly. That's a losing game, and it feeds right into fear and greed. Your real, achievable objective is to shift your focus from price to value. The goal is simple, it's rational, and it's repeatable. Buy a great business when its price is low and sell it when its price is fair. That's it. That is the whole game. This one idea, this single philosophy, is the shield that protects you from the emotional extremes of the market. It anchors your decisions in a rational process, in value, not in the chaotic noise of how you or the rest of the market feels on any given day. So I'll leave you with this question. The next time you're about to make a trade, whether you're feeling panicked or feeling brilliant, just stop for a second and ask yourself, am I doing this to make my ego feel good right now? Or am I doing this as part of a rational plan that's built for tomorrow? The answer could save you from a whole lot of heartache and a whole lot of money. Hey, welcome! So forget about treasure maps and pirate chests for a little while. Today, we are going on a totally different kind of scavenger hunt. And the prize? It's not gold, it's not jewels, it's something that could be way more valuable. Your next great stock investment. Let's jump in. You know, it's a question every single one of us faces as an investor. We've all been there, right? You make a good call, you sell a position, and bam. Now there's this empty space in your portfolio. That cash is just sitting there, waiting. So the huge question is, what's next? Where do you even start looking for a new idea? You see, here's the thing. Being a really disciplined investor isn't just about knowing when to cash out. When you have a strict sell discipline, it actually creates this constant pressure. Your portfolio turnover goes up, and that means you have this pressing need to find new, promising companies to fill the spots of the ones you just sold. The hunt? Well, it's pretty much always on. So here's our game plan for this hunt. First, we're going to talk about why this is a continuous scavenger hunt. Then we'll get into mapping out our hunting ground to find those overlooked territories. After that, we're going to open up our toolkit of stock screeners. Then we'll learn how to follow the trails of the pros. And finally, we'll get to the most important part. Why, at the end of the day, the conviction has to be all yours. Okay, so before we grab our maps and our tools, let's really get the lay of the land. Why is this hunt for new ideas something you have to do all the time to be a successful investor? Why isn't it just a one-and-done kind of search? Well, it's really just simple cause and effect. When you have a clear-cut strategy for selling, maybe a stock hits your price target or the company's story changes, you are, by definition, creating empty slots in your portfolio. So to be a disciplined seller, you are forced to become a disciplined buyer. And that absolutely requires a pipeline of fresh, well-researched ideas that are ready to go. Every good scavenger hunt starts with a map, right? You don't just wander around hoping to stumble on something. You look for the promising spots, the places where treasure is most likely to be hidden. And you know what? In investing, our first step is exactly the same, mapping out whole areas of the market that other people have just completely given up on. And our map, it comes in a super modern form, exchange-traded funds, or ETFs. Now, hold on, we are not talking about buying the ETFs themselves. Nope, we're using them as this incredible diagnostic tool. They can show us almost instantly which whole sectors or industries are deeply, deeply unloved. I'm talking about the ones staring into the abyss of multi-year lows. And that is where a true contrarian investor starts to get very, very interested. And the detail on this map is just incredible. I mean, ETFs slice and dice the global markets in every way you can possibly imagine. You can look by sector, like tech or healthcare. You can look by specific stock characteristics, or by investment style, like value versus growth. You can even look by geography. A quick look at how ETFs are performing is like getting this global intelligence report that points you right to the most promising hunting grounds. All right, so our map has shown us where to look. We've pinpointed a promising, totally unloved corner of the market. But that's still a pretty big place. How do we find the actual gems that are buried in there? For that, we need to unpack our toolkit. These are the specialized tools we're going to use to sift through all the noise and uncover real, measurable value. You know, the most fundamental tool for any value investor is the stock screen. Think about it this way. Stock screening is to value investing what apple pie is to America. It's an absolute classic. Because the stock's cheapness is something you can actually measure, we can use screens to filter through a universe of thousands and thousands of companies and boil it down to a manageable list of potential ideas that fit our very specific criteria. A perfect example of this is the brilliant and brilliantly simple formula from Joel Greenblatt's famous Little Book That Beats the Market. It's a two-part model that doesn't just look for cheap companies, it looks for good companies that also happen to be cheap. You rank stocks on cheapness, which is a low PE ratio, and you rank them on quality, which is a high return on equity. The ones that score best on both, those are your top prospects. It's just a really elegant way to find quality at a bargain price. Of course, there are a ton of ways to measure cheap. These right here are the classics, the low price to anything screens. And the goal is super straightforward. Find stocks that are inexpensive compared to some core business metric. So whether you're comparing the price to its earnings, its book value, its sales, or its cash flow, you're really just asking one fundamental question. Am I getting a lot of business for the price I'm paying? But you have to be careful. A simple PE screen can sometimes fool you. A fantastic company might have one terrible year, right? Maybe there was a temporary setback or a bad recession. Its current earnings are in the tank, which makes its PE ratio look sky high. It looks expensive. A more advanced move is to use what we call normalized earnings, maybe a 3 or 5 year average. This smooths out all those bumps and gives you a much, much clearer picture of the company's real long-term earning power. Let's add 2 more specialized tools to our kit. First, the hitting the bottom screen. This one's for the real contrarian, the person actively looking for stocks the market has just completely thrown away. And then there's the net screen. This is a deep value classic from the legend himself, Benjamin Graham. This looks for companies trading for less than their net current assets. We're talking cash, inventory minus all debts. You're basically getting the business and its future earnings potential for free. It is the ultimate bargain hunt. Now this is a fun one. It's a really contrarian tool, the analyst sentiment screen. Instead of looking for stocks that everybody loves, you actively search for the ones Wall Street analysts can't stand. I mean, when a stock is just covered in sell ratings, it often means all the bad news is already baked into the price, leaving a lot more room for a positive surprise. You could even screen for stocks where, say, 90% of the ratings are sell or hold. And hey, when you run that screen, here's a crucial piece of insider info you need to know. On Wall Street, a hold rating, it rarely means hold. Analysts often use it as a polite way of saying sell without making the company's management mad at them. So when you're doing your math on that non-buy percentage, treat those holds as what they usually are, weak sells. So far, everything we've talked about has focused on using our own maps, our own tools. But what if we could learn from the master hunters themselves? Our next strategy is all about following the tracks of proven expert investors to see what treasures they're digging up. This quote, it just perfectly captures the spirit of what we're talking about here. We're not talking about cheating or anything. We're talking about learning from the absolute best. I mean, why not start your scavenger hunt by looking at the ideas that some of the world's most successful investors are already putting their money into? So how do we actually do that? Well, the key is this number right here, $100 million. You see, the U.S. Securities and Exchange Commission, the SEC, requires any institutional investor that manages over $100 million to publicly disclose all their stock holdings every single quarter. And that little rule gives us a direct window right into their portfolios. And the process itself is actually pretty simple. First, you make a list of investors whose philosophy you really admire, and it's so important that their style fits your style. Then just double-check that they manage over that $100 million mark, which means they have to file with the SEC. From there, you can use online resources to track their quarterly filings.
Now think of their portfolio not as a shopping list, but as a powerful pre-vetted list of ideas that can be the perfect starting point for your own research. Okay, this brings us to what might be the single most important point of this whole discussion. It doesn't matter if you found an idea using an ETF map, a fancy screen, or by following a master investor. The hunt is not over. In fact, the most critical work, the work that truly makes or breaks the investment, is just beginning. And it is all on you.
I cannot stress this enough. This is a huge warning. Finding a promising idea is just step one. You can't just blindly copy another investor. I don't care how great their track record is. Using their ideas as a starting point, that's smart. Using them as the finish line, that is a recipe for disaster. So why is this so critical? Well, think about it. Without doing your own deep dive, you will have no idea what to do when that stock drops 20%. You won't have the conviction to hold on or the knowledge to know if it's actually time to sell. You also need to make sure that the original investor's success wasn't just a lucky break. And most importantly, you have to build your own conviction. Because investing without conviction, well, that's just a fancy word for gambling. So we've mapped the territory. We have unboxed all the tools. We've even learned from the masters. The methods are right here, they're waiting for you. So the only real question left is this. With all these new strategies in your back pocket, where are you going to begin your scavenger hunt?
You know, there's this really powerful idea out there that the way we've all gotten comfortable thinking about the economy, well, it's not just a little outdated, it's actually become dangerous. The message is pretty clear. The good old days of blissful ignorance are over. It's time for all of us to pull our heads out of the sand and face some new and, let's be honest, pretty uncomfortable truths about the world's economy.
So why the sudden wake-up call? Well, let's take a trip back in time for a second. Think about the 80s and 90s. If you were an investor, life was pretty good. It was a time of almost non-stop growth. Honestly, trying to analyze the big picture, the whole macroeconomy, it kind of felt like a waste of time. I mean, why would you bother when just about everything was pointed up and to the right?
And this slide just nails it. The economy back then basically came in 3 flavors: good, great, and awesome. If you messed up and misread the signs, what's the worst that could happen? You just make a little less money. No big deal. But as we've all learned the hard way, the global economy now has a few other flavors on the menu: bad, horrible, and yeah, downright nasty. And the price for getting it wrong today, it's infinitely, infinitely higher. Okay, so here's the game plan for this explainer. We're going to start by waving goodbye to that blissful ignorance and get a handle on the problem with these false beliefs. Then we'll dive into what's being called the U.S. steroid economy. After that, we're looking at 2 huge global risks: Japan's lost decades and China's great gamble. And we'll wrap it all up with a playbook for how to actually invest in this crazy, risky new world. All right, let's jump right into the heart of the problem. We all tend to operate based on beliefs that, yeah, they worked great in the past, but they are just dangerously out of touch today. And it's this exact reliance on old, comfy assumptions that gets people into a world of trouble. Now, to really wrap our heads around this, we need to understand a key concept: the false axiom. So a regular axiom, right? That's something we just accept as a self-evident truth. You know, like 2 + 2 is 4. But a false axiom, that's different. That's a belief we've started treating as a fact, just because it's been true for a really long time, based on all the data we had. It's a super dangerous assumption just waiting to blow up. And what's the most famous, or maybe infamous, false axiom in recent memory? The belief that U.S. real estate prices never, ever go down on a national level. I mean, for over 50 years, all the data backed this up. Everybody, and I mean everybody, from the Federal Reserve down to the biggest banks on Wall Street, believed this was a law of nature. And that one single belief led to way too much building, way too much borrowing, and then, of course, the 2008 financial crisis, when that unbreakable truth just spectacularly fell apart. So that crisis led to this massive government intervention. And to really understand the U.S. economy after all that intervention, our source material gives us this absolutely brilliant analogy. It calls it the steroid economy. So picture this. You've got a marathon runner. He gets injured, but he's got another huge race coming up. So what does he do? He gets pumped full of industrial-strength steroids, and boom, suddenly he's running faster than he ever has. From the stands, his performance looks incredible, right? But what we can't see is what's really going on under the surface. Well, that athlete, that's the U.S. economy, propped up by trillions and trillions of dollars in stimulus. And this slide just lays out the side effects perfectly.
First, the steroids make performance look way better than it is, creating this false sense of stability. Second, just like a drug, they're addictive. I mean, trying to stop the stimulus is politically painful, so it just keeps getting extended. Third, over time they stop working as well. You need a bigger and bigger dose to get the same kick. And finally, the really nasty part, the long-term damage, which means massive government debt and the certainty of higher taxes in the future to pay for it all. Now, this whole path of stimulus and debt, it's not exactly new. If you want a chilling preview of where this road can lead, we just have to look at the world's third largest economy. This is the story of Japan's lost decades, a crisis that was, believe it or not, entirely predictable. And this brings us to another really important idea, the gray swan. I'm sure we've all heard of a black swan. That's a totally rare, unpredictable event that changes everything. Well, a gray swan is a little different. It's also rare, it's also a huge deal, but here's the key. It's predictable. We might not know the exact day it's going to happen, but we know it's coming. And Japan's economic future? It's a textbook gray swan. So what makes Japan such a gray swan? Well, it starts with the mind-blowing scale of their problem. After Japan's own massive bubbles popped back in the 90s, they went on this 2-decade-long binge of nonstop stimulus. And the result, as you can see clear as day on this chart, is a government debt that's over 200% of their entire economy. That's more than double the US or Germany. It's just a staggering, staggering number. But listen, that mountain of debt is only half the story. See, sometimes a country can grow its way out of debt, but Japan can't. Its population is actually shrinking, and it's getting older, fast. 1 out of every 4 people there is over 65. The birth rate is way, way below what's needed to replace the population. And the real kicker? That legendary Japanese savings rate, the one that used to buy up all the government's debt, is now getting close to 0. There's just no engine for growth left. So what's the end game here? How does this play out? Well, Japan can't really default on its debt. Most of it is owned by its own citizens, and they definitely can't afford higher interest rates. So that leaves only one door open, the one that governments always take when they have their own currency. They print money. As the famous economist John Maynard Keynes once said, inflation is a way for a government to confiscate secretly and unobserved an important part of the wealth of their citizens. The inevitable end would be this shocking jump from decades of no inflation to hyperinflation, absolutely wiping out savings and crashing the value of the yen. So if Japan is a massive gray swan, then the world's second largest economy is something even bigger. Let's turn our attention to China's great gamble, what our source calls the mother of all gray swans. To really get what drives China's leaders, you have to imagine their economy like that bus from the movie Speed. You've got 1.3 billion people on board, and the government is gripping the steering wheel. If that bus slows down, if economic growth even stumbles, the whole thing explodes into social and political chaos. This puts unbelievable pressure on them to keep that growth going, no matter what it takes. But growth at any cost has created some incredibly low-quality, wasteful growth. And this slide really highlights the problem. We're talking about the world's second largest shopping mall, and it's been sitting basically empty for years. We're talking about entire cities like Ordos, built to house 1 million people, but they're now just eerie ghost towns. The scale is hard to comprehend. China has more idle steel capacity than Japan and South Korea produce combined. This isn't productive investment. This is the economic equivalent of just digging holes and filling them back up again. And if you want to try and grasp the just mind-bending scale of this bubble, check out this quote from the famous investor Jim Chanos. 30 billion square feet of real estate being built. He says that's enough to give every single person in China, every man, woman, and child, their own little 5-by-5-foot cubicle. It's a bubble of truly historic proportions, and it's all built on that false axiom that this crazy growth will just go on forever. Okay, so we've laid out some absolutely massive risks. A U.S. economy that's basically on life support, what looks like an inevitable crisis in Japan, and a historic bubble in China. That's the bad news. The good news? Understanding these risks actually gives us a framework for how to act. This is the realist playbook. So what's the advice? First, you want to minimize your exposure to industries that ride the economic waves, like commodities and materials, because they're super dependent on that unsustainable Chinese growth. Second, you need to demand a much bigger margin of safety when you buy stocks, to protect yourself from all this uncertainty. And third, you want to focus on truly high-quality companies. What does that mean? It means businesses that have pricing power. They can raise prices if inflation hits, and they have rock-solid debt-free balance sheets that can survive any economic storm. But it's really hard to act on these kinds of risks when everything on the surface seems fine. Take the story of MBIA, a company that insured bonds. The author's firm sold the stock when MBIA started insuring really risky, complex bonds. And for 7 years, that looked like a really dumb decision because the stock just kept going up and up. Then 2008 hit. Those risky bonds blew up and MBIA was completely wiped out. And this right here is the critical lesson from all of this. Hope is not a strategy. Just because a risk hasn't blown up yet doesn't mean it won't. The hardest part of investing isn't just figuring out the truth. It's having the mental toughness to actually act on that truth, even when it's unpopular and feels like you're way too early. So after laying all of this on the table, we're left with one last question. Some people might hear this analysis and call it pessimistic, and label the person delivering it Mr. Doom. But the author proposes a different title, Mr. Realist. See, a realist doesn't try to touch up the X-ray to make it look better. They see the risks for exactly what they are, and they prepare for them. So the question for all of us is, which one are you?
Welcome back to The Explainer. Today, we're going to tackle two of the biggest ideas in all of investing: risk and diversification. But we're not going to do it by the book. No, we're throwing out the textbooks, and instead, we're going to look at how the pros, the real practitioners, think about this stuff. It's time to think a little differently.
All right, so let's just dive right in with the most fundamental question there is. When you think about investment risk, what are you actually afraid of? Is it just your stocks bouncing around day to day, or is it something deeper, something permanent? Because how you answer that question changes everything about how you invest.
And this is where things get really interesting. You've basically got two different camps. Over on one side, you have the world of academia, and they'll tell you risk is volatility, how much a stock price jumps around. But then you've got legends like Warren Buffett, and to them, all that daily noise is just, it's noise. For them, the real risk, the thing that should keep you up at night, is the permanent loss of capital, the chance that your money is just gone, for good.
So, which one is it? Well, honestly, it all comes down to your time horizon. Think about it. If you're in this for the long haul, say 5 years, 10 years, or more, a stock price dropping temporarily isn't a disaster. In fact, it's an opportunity. It's a sale. The real boogeyman is owning something that goes to zero, because no amount of time is going to fix that. For a true long-term investor, permanent loss is the only risk that really matters.
Okay, so this leads us to a really fascinating idea. The biggest risks you face are often the ones you can't even see. They're not in the past performance numbers. To find them, you have to explore what could have happened, but just didn't. These are the alternative histories. Let me tell you a quick story to make this crystal clear. Picture this. There's a CEO, and his company's entire operation is based on one tiny island, Grand Cayman. Now, as you can probably guess, this place gets its fair share of hurricanes. And this CEO, he's trying to find a clever way to boost profits, and he comes up with a very, very bold plan.
So, what does he do? He cancels the company's hurricane insurance, just gets rid of it completely. His logic is, hey, why are we wasting millions on premiums every year? And in that first year, wouldn't you know it, his bet pays off big time. No hurricane hits. All that money they save drops straight to the bottom line, and the company has its best year ever. He looks like an absolute genius.
So here's the million-dollar question for you. Does this guy deserve a massive bonus? Or should he be fired on the spot? If you only look at the outcome, the record profits, he's a hero. But that way of thinking is so incredibly dangerous because it completely ignores the gigantic invisible risk he took.
And this number, this is the smoking gun. Looking back at over 100 years of data, there is a 44% chance of a hurricane hitting that island in any given year. That is almost a coin flip. The CEO didn't have some secret weather machine. He didn't know something nobody else did. He just bet the entire company on a coin flip, and he happened to get lucky.
This quote from Walter Wriston just nails it. The point of all this isn't to avoid risk. That's impossible. The point is to understand the risks you're taking, to manage them intelligently, and most importantly, to not confuse getting lucky with being smart.
And believe me, this isn't just some theoretical story. This stuff happens all the time. Think about it. You see a mutual fund that tripled its investors' money. Amazing, right? You want in.
But what if you popped the hood and found out that half its money was piled into super volatile energy stocks right at the absolute peak of an oil boom? Sure, the returns were real, but they were fueled by a massive hidden gamble that just happened to work out. That's hidden risk.
So the crucial thing to remember is that there's the risk you can see, the day-to-day volatility, and then there's the hidden risk, the potential for disaster that's lurking under the surface, the thing that hasn't happened yet. And it can be caused by anything, really. Too much debt, a huge bet on one sector, or a manager who just got plain lucky. The next time you see some unbelievable returns, you have to ask yourself, what am I not seeing?
This idea of hidden risk flows perfectly into our next topic, and it's one of the most debated things in investing: diversification. We always hear it's the only free lunch, but the reality is it's a huge dilemma with two really dangerous extremes you can fall into.
So on one side of this debate, you've got the master himself, Warren Buffett, and his argument is incredibly powerful. He basically says that if you've really done your homework and you truly understand a business, then spreading your money all over the place doesn't make you safer. It just waters down the returns from your best ideas. But to really get the other side of the argument, you have to understand the psychology of risk. So let's talk about a real guy, we'll just call him Jack. His story is a really powerful lesson in what can happen when you're not diversified enough.
See, Jack and his wife both had great, long careers at this big insurance company, Marsh & McLennan, and over all those years, they put everything into the company stock. I mean, their entire net worth was tied up in it, and everything was going great until one day, it wasn't. Jack gets a phone call. The New York Attorney General is filing a massive lawsuit against the company, and bam, the stock gets cut almost in half, just like that.
Now here's the really crucial part. The day before that phone call, the chance of a giant like Marsh & McLennan going bankrupt was practically zero, unthinkable. But now, watching his entire life savings get vaporized, that tiny, remote possibility suddenly felt terrifyingly real. And that's the key. When you can't afford to lose, you can't think straight. Your brain just short circuits. And under that insane pressure, Jack sold a huge chunk of his stock at a massive loss.
But okay, let's swing the pendulum to the complete opposite extreme. This is what Buffett is talking about here. It's the danger of over-diversification. When you own 50 or 75 different stocks, he says it's like a Noah's Ark approach. You end up with a zoo. You've got this huge collection of stuff, but you don't really know anything about any of it.
So this really frames the dilemma perfectly. On one side, you have the Jack story, under-diversification. It exposes you to catastrophic loss and basically destroys your ability to make rational decisions. But on the other side, you've got the zoo portfolio, over-diversification. And that just leads to ignorance, because you can't possibly know that many companies, and eventually indifference, because who cares if one stock goes up or down, it barely moves the needle. So, where does that leave us? How are you supposed to navigate between these two really bad outcomes? Well, the goal isn't to find some single magic number that's precisely right. The goal is to be vaguely right, which is a whole lot better than being precisely wrong.
Now, academics can argue about the perfect number till they're blue in the face. But out here in the real world, one number keeps popping up again and again as a practical solution: 20. For most of us, a portfolio of around 20 well-researched stocks seems to be the sweet spot. It's become a rule of thumb for a reason.
So why about 20? Well, it kind of gives you the best of both worlds. It's enough diversification to protect you if one of your companies has a disaster like Jack's did, but it's also a small enough number that you can actually do your homework and know what you own. It keeps you engaged, and it avoids that zoo problem where you just become indifferent.
But here's the last and maybe most important piece of advice. Once you've built your portfolio, you're not done. The final step is to actively stress test it. You got to play out those what-if scenarios. Ask yourself, what if there's a recession? What if oil prices go crazy? You're trying to find the hidden cracks in your own logic before the market finds them for you.
And that really brings us right back to the beginning. Any portfolio can look safe and smart based on what's happened in the past. But true risk management is all about preparing for what could happen in the future. It's about looking for those alternative histories before they become your reality. So the real question is, what hidden risks are lurking in your portfolio right now, just waiting to be revealed?
You know, every single investor, no matter how confident they are, has this one tiny nagging question in the back of their mind. What if I'm wrong? I mean, what if the future you've planned for, the one you've bet on, just isn't the one that shows up? In this explainer, we are tackling that question head on. We're going to stress test a very specific investment strategy against, well, pretty much whatever the market can throw at it. Let's dive in.
So here's the game plan. We're going to start with that big, central question every investor has to face. Then we'll introduce the strategy we're putting under the microscope. It's called active value investing. From there, we're going to run it through 3 possible futures: a crazy, roaring bull market, a terrifying bear market, and that frustrating go-nowhere sideways grind. And then, at the end, we'll pull it all together for the final all-weather verdict.
Okay, let's kick things off with the absolute foundation for our entire analysis, the challenge of making a forecast. I mean, you can do all the research in the world, build these incredibly sophisticated models, but the future, it's always going to be uncertain. So the real question is, how do you invest intelligently in a world you can't perfectly predict?
Now, based on a deep dive into historical conditions, the most probable forecast is that the next decade is going to be a sideways market. What does that mean? Well, lots of ups and downs, plenty of volatility, but not a lot of overall upward progress. But here's the key, and you really got to get this. Probable is not the same thing as certain, not even close.
And this, right here, is the absolute heart of the matter. The argument is that any investment strategy has to be judged not just on how much you could make if you're right, but, and this is so important, on what the cost is if you're wrong. It's a huge shift in how you think about things, right? You move from just chasing gains to really examining the downside.
So what do we do with all this uncertainty? Well, the legendary coach Pat Riley actually gave us a pretty solid playbook. He said, look for your choices, pick the best one, then go with it. For investors, that means you have to analyze your options, you have to stress test them, and then you commit to the one that gives you the best odds of success no matter what happens. So let's take a look at the best choice being proposed here.
All right, so the strategy that's being put on the table here is called active value investing. The idea is that this is the best choice to navigate these kinds of uncertain market waters. So let's break down what that actually means. At its core, you can think of active value investing like this. Imagine you're a really savvy shopper, but for stocks. You're not just looking to buy high-quality stuff, you're waiting for it to go on sale. You want to buy fantastic companies, ones that are strong, growing their earnings, paying out dividends, but you have this strict discipline. You're only going to buy at a price that makes sense, and that gives you a built-in margin of safety.
Okay, so this whole thing really stands on 4 key pillars. First, you only own high-quality companies, no junk. Second, you make sure their earnings are actually growing. Third, you're on the hunt for what the source calls fat dividends. That's a reliable stream of income. And fourth, and this is like the golden rule that holds it all together, you only buy with a margin of safety. You're paying a price that gives you a cushion, just in case things don't go exactly as planned.
All right, let's get to the fun part. Time for our first stress test. So the forecast says sideways, but what if that's dead wrong? What if we're on the verge of a massive, rip-roaring bull market? How does our disciplined, careful strategy hold up when it feels like everybody else is getting rich overnight?
And this is a really honest and I think important admission. In a crazy bull market, this strategy is not going to be the star of the show. It is not going to punch the lights out. Why? Well, because that discipline we talked about means you're going to be passing on those super speculative, high-flying stocks that are probably way overvalued. But, and this is a big but, you should still see solid returns because you own high-quality growing companies. So you'll definitely participate, you just won't be reckless about it.
Okay, now for the big one, the test that really matters. What if the forecast is wrong in the complete opposite direction? What if a vicious bear market comes out of nowhere? This is where people can lose their shirts, and it's where the true strength of a strategy is really put to the test.
But here's something you've got to understand, and it's a huge point. Not all bear markets are created equal. Just saying bear market isn't enough. The reason for the downturn matters a lot. So we need to look at 2 totally different kinds of bear markets. A deflationary one, like what Japan went through, and an inflationary one, like Germany saw after World War I.
Okay, so take a look at this breakdown. It's fascinating. In a deflationary world where prices are falling, active value investing would probably do worse than just holding super safe treasury bonds. But even then, look, corporate bonds would get totally hammered. Now check out the second scenario, the inflated bear market. This is where the hidden danger lies. Active value investing gives you relative protection, while all bonds, I mean all of them, give you terrible returns in real inflation-adjusted terms.
Let's dig into why that happens, because it's really important. In a deflationary recession, cash is king. Prices are falling, so the money you have becomes more valuable. Those guaranteed payments from a government bond look amazing. But in an inflated bear market, it's the total opposite. High inflation just eats away at those fixed payments from a bond. The money they pay you buys less and less every single year. Your purchasing power gets destroyed, making bonds a surprisingly risky place to hide.
Okay, so we've seen how this strategy handles the extremes, the bull and the bear. Now, let's see how it's designed to actually thrive in the scenario that's considered most likely, that choppy, volatile, sideways market.
So what exactly is a sideways market? Well, it's just frustrating, right? The market indexes aren't really going anywhere over the long haul, but day to day it's a roller coaster of nerve-wracking ups and downs. For a lot of investors, that's a recipe for disaster. But for this strategy, all that volatility, that's actually an opportunity. So in this kind of market, the strategy has three big things going for it. First, because it's an active process, you can use that volatility to your advantage, buying good companies when they dip and maybe selling when they get a little ahead of themselves. Second, that price discipline means you'll naturally have cash on hand sometimes. That's your dry powder to jump on great deals when they pop up. And third, when the market isn't handing you big capital gains, those fat dividends become the engine of your total return.
And this is why that word active is so darn important. You're not just buying and holding on for dear life. You are actively on the hunt for value, looking for those specific stocks that meet your quality, your value, and your growth criteria, right in the middle of all the market chaos. Volatility stops being your enemy, and instead it becomes your ally.
All right, so we've put this strategy through the ringer. We've seen how it does when the forecast is spot on, and maybe more importantly, how it holds up when the forecast is completely wrong. Let's pull all this together and issue the final verdict. And this chart, it really pulls the whole logic together. You can see the assessed probability for each market type. Sideways market, high probability. Bear market, low. A big bull market, very low. So the active value strategy is built, it's optimized for the outcome that's most likely, while still giving you really solid protection in those other, less likely scenarios.
So, look, the bottom line is this. Active value investing is not about trying to hit a home run in every single market environment. It's about building a portfolio that can play great defense when things get ugly, solid offense when things are great, and has a specific game plan to keep scoring points in what might be the most common environment of all, that choppy sideways grind. It's a strategy built for resilience.
And that really just leaves us with one final, and I think crucial question to ask yourself. It's not about whether your market forecast is right. It's about what happens to you and your money if it's wrong. So take a hard look at your own portfolio, your own strategy, and ask, is this thing built to survive and maybe even thrive if I'm wrong? That is definitely something worth thinking about. Thanks for joining us.